All right, hello everybody. Hey, I'm Greg Anderson. If you've read Arctic Startup, you've probably read one of my stories. And I've been working for Arctic Startup for about 2 years now, and I've written tons of stories about companies receiving funding. And the big emphasis there always seems to be on how much money it is and like what the valuation is. Like those are the two factors that seem to really count to startups. But what's also really important is what that money is buying. So we're really excited to throw this event today about for a term sheet battle, where we get to see like what goes into these term sheets that eventually impacts these startups' lives. So just want to talk a little bit about what we're doing at Arctic Startup. Like since Arctic Startup kind of went through a rocky winter, since then we we've just hired a CTO, and what that means is we're going to start trying to put out more tools and services for all of our readers. And then, yeah, let Dimitri take it from here.
Yeah, and I mean, when a startup hires a CTO, that's a great thing. And I think it was a very important decision for Arctic Startup. And we don't want to be just a media blog anymore. We want to, talk to you guys, and we want you to be more involved with whatever's happening. And one other important thing that we are doing is we are opening up a co-working space in central Helsinki. At Aleksantrin Katu. I'm not going to say the numbers just yet. We want to keep it a bit of a rumor. But I think it's a big step forward for the ecosystem. We'll have a place to hang out, to drink tea, coffee, beer, and vodka. And, we'll have a perfect term sheet room in there as well. We're going to open sometime during the summer. And Newco Factory Incubator is helping us out with this. We're doing it together. These are the people over there, so speak to them, definitely. And this is still at the rumor stage, so feel free to talk to us, send us emails, and we'll let you know what's happening. That's pretty much it from the Arctic Startup side. I think we don't want to, stand in between you guys and the actual event. So I'm going to give the microphone to Lars from Startup Bootcamp, who's been helping us to organize the event. We were throwing it all together. So Lars, welcome.
Thank you. Thanks, guys. First, a huge thank to Arctic Startup, guys. What a great venue to have this event. Could be more people, but I think it's a very, very decent show up. All you guys standing there, are you going to stand there for 4 hours? I will check it. Okay, cool. I'm not here to do a big advertisement for Startup Bootcamp. I spent 15 years in Nokia. I've been in Helsinki more than 200 times. I just calculated when I left. I joined Startup Bootcamp. All of you guys know Startup Sauna. There's other accelerators out there. Don't know if you know. So when you guys run out of Techis money and bridge entrepreneurship grants, check them out. We just landed a couple of new deals for the program, and which means that we are now able to offer the startup teams joining the program the best deal in the world, actually. Cool. We are here to talk about term sheets. Everybody have seen Shark Tank and the like, kind of where it's just a price put on equity, and then you continue life as nothing happened. This is not really how it goes on when the VC guys meet the startups. We'll bring the cast on stage in a minute. We have one great sponsor, which everybody I am sure also know. Antti from UpCloud used to head the Arctic Startup. Now he's going into private business. Don't know what the hell what happened there. But Antti, say a few words about your new company.
Thank you. Hey, I'm Antti. I used to work for Arctic Startup. I was partly to blame for that rocky winter Greg there mentioned in the beginning. So I'm also the founder of Arctic Startup. I started the blog in 2007. So it's been a long ride, and it's great to see Greg and Dimitri doing an awesome job with events like this, because I I think the ecosystem still isn't quite as self-sustaining as it could be, so these are definitely really important events. And I don't want to take too long, but once the opportunity came to support this event, we really wanted to step in because we value what these guys do and how it helps startups forward. So I'm here representing UpCloud today, and just a few quick words what we do. So we are a scalable, on-demand, pay-as-you-go infrastructure service provider. And if you move on to the next slide, there are a few differences that make us, in our opinion, better than the big players in the world. And we do really believe that we are able to provide some really excellent value to startup companies and even bigger companies looking to cloud host their services. Just a few things are the freely scalable server resources, why settle for instances from other providers, and ease of use, constant high performance across all service levels. A certain big international book company, let's put it that way, sort of pushes down a little bit too much on the smaller packages you guys might run your servers on. So we really value all levels of business and strive to excel in that. And if you move on to the next one as well, why us and not someone else? We really took a look at the market and think that while the big companies are the major owners of the market share at the moment, they do a lot of things wrong, and that of course is an opportunity for us, but also an opportunity for you guys to run your business better. So we are running this show on our own software, on our own stack. So we combine the hardware and software together. So we are able to provide one of the most competitively priced cloud hosting services in Europe at the moment. It's also very redundant. And one of the great reference cases we have is the Ministry of Justice here in Finland. So if they're able to trust us, I'm sure other organizations can as well. So I urge you all to test it out. And if you want to have a free test, I've got some €100 vouchers in my pocket. So if you didn't get one at the door, come say hello to me and I'd be glad to give you a voucher to test out the service. So run your stress tests there, and we'd be eager to hear your feedback on our service as well. But without further ado, I'll pass it over to the gents and let the show go on. Thank you.
Thanks, Antti. On the first row here, we have Jimmy from Sunstone, and we have Daniel from Crandom. Two VCs that actually have money to spend. We meet a lot of guys out there with old funds, but I guess, Jimmy, your fund is 1.5 years old, and Crandom just raised a new one. So these are the guys to talk to with the hot startups. And then we have Kimmo from Bird & Bird. Super experienced in doing these kind of deals, and he will be supporting Mika, serial entrepreneur, with a special feature that he have actually raised real money. Right, Mika? Cool, good. And then Brad, he jumped on stage. Brad's going to be our referee, lawyer from Seattle, turned rogue, now serial entrepreneur out of Copenhagen. But Brad, I will give you the mic, and then the battle is kind of ready.
All right, perfect. Okay, welcome to Term Sheet Battle Helsinki. Have to say I'm really pleased that Arctic Startup Bootcamp, and the cast have contributed so much time and energy to put this battle on. Turns out Jimmy is an old pro. This is his third battle. The format is pretty straightforward. It's a little bit like a boxing match in this respect. Hopefully no blood, no bruises, but we are going to have rounds. And there's about 10 or 12 issues that we selected. And in any term sheet, there could be 100 issues, but we're going to focus on 10 or 12. And the way this works is we want to try to create content that's local and relevant. And so some documents were circulated among the cast, and the cast had a chance to mark those up. And so for me, it's an improvisation. And for all of you and for everyone on stage, this has not been scripted. I think People have a plan, but we'll see how it goes. And so we're going to start this off. The hypothetical, of course, is that Ravenous Ventures likes this deal, mobile gaming software, and they have presented a term sheet. This is the first meeting. All these documents, by the way, are available on the Arctic Startup website. And so I'm going to turn it over to the cast. Now, one of the other things, because it's supposed to be fun and entertaining, maybe a deeper dive than Dragon's Den, but we are going to take a time out from time to time and sort of say, okay, what happens in the real world? Because we do hope that everybody, walks out of here learning some things. And so there's the role play, and there's going to also be opportunity for Q&A. So I'll turn it over to Kimo.
Thank you for everybody for being here tonight and for being able to discuss this term sheet. So we have gone this through with Mick, and as you can imagine, we have some concerns regarding the contents of this term sheet.
This plain vanilla term sheet.
Well, we'll see. We have some concerns and some questions, and we have talked about those with Nick and also the other founders, and let's see how far we are able to get this evening. But I guess, Nick, you can start with our concerns.
Mick, good to see you last week, actually. We enjoyed it. But I have to say, we already start off on a wrong footing on this meeting, because you as a serial entrepreneur, you enter the room, right, and you take your bodyguard with you, even though we told you that we would rather take the first round of discussions without attorneys, right? I mean, that's quite disappointing. I thought you were experienced. I mean, you've done US deals. And
he's my witness, that's only.
It's a witness? Okay.
I need a
as
witness.
long as the witness is silent, that's okay.
Yeah, there's obviously not just the concerns of Mikke, but
no offense
also
Mikko.
also the other founders who were not able to be here tonight. So I can also tell their message to you.
So, as you are so talkative,
Unlike Finns, you mean?
can you please tell me, what's the rationale behind this? Just so that we set the stage.
Get some money into your company and expand it.
Okay. And what's the interest here? Is it the team, or is it is it the founders, or is it the product, or what are you really interested in here?
We are interested in the business opportunity, and we think that the team has given us a very good impression. So we're thrilled.
I think we've been sold sort of at your and the team's vision. You want to create this big, valuable company, and we really like that.
Okay, good. So it's like the upside that you're looking for.
Absolutely.
Good. So it's not, okay. What kind of upside, by the way?
Excuse me?
What kind of upside?
Well, you told us $1 billion, right?
5 times?
I mean, the return on investment, or?
Yeah.
Well, certainly 5 times is not enough for this early stage.
Okay, good. So, my point of view, I read through this. Pretty okay. There's some.
Let's sign.
Well, it's a very typical term sheet, I would say, from you guys. You come with a valuation, and you say that you're meeting our valuation requirements. But if you really read through this, the price is something completely different. So what you're expecting us to do, instead of giving out 20% to the company, is to give out more than 50% to the company. So just to set the stage.
Well, I mean, looking at your burn rate right now, the 750 is going to take you like 8-10 months. You're going to fundraise. You need fundraise for the B round at least 6 months, so you need to fundraise again in 2 months. That didn't really make a lot of sense to us. So that's why we said, why don't we try to see if you can at least have a runway of at least 12 months. So that's the reason.
That's your belief. I mean, from our point of view, we know this money is enough for us to take us to profitability. So we don't need any more money.
We have heard that before.
Yeah, we know that. Anyhow, so just to set this stage, so you're meeting our valuation. That's nice. That's the only generous thing you're doing here.
Which, by the way, is an immense markup given the valuation that you had 3 months ago.
Yeah, but we've been, the track record has shown that we've been doing it 3 times.
The hourly rate is quite high, right? From 1.25 to 3 million free in 2 months.
Well, you're taking it down to 1.5. So let me just, explain to people here what you're doing. So basically, what you're doing is you're saying that, okay, first you want to have one tranche 20, second tranche 33, okay? Then you want to have options pre, and a pretty high option.
They're not for us. They're for the company.
Of course, but it's out of my pocket. It's not out of your pocket. You want to have a liquidation preference, another one. You want to have dividends, somehow hidden here that you want to have dividends as well to cover your, to basically show to your investors that you're doing a good, return. You want to have a first right of refusal and a buyback.
We're in the return business.
Yeah. But what I'm saying here is it's pretty, the price is going up all the time. The valuation is the same, but the price is going up.
It's pretty standard term sheet.
Nah, I wouldn't say that. So let me that's the kind of the stage here. So, it's in the details really what I want to look at here. It's not on the valuation side. I'm fine with the valuation. I think you're generous, you guys. So, that's really good. But let's take a look at, for example, at the price side. I think if we agree...
But you said the price side was fine.
No. I say valuation is fine, but price is something completely different.
Okay.
So what I want to do is I want to make sure that we agree on the price, because that's really where it comes into. So let's start, for example, with a milestone. What do you want to put in 750? I just want 750. So why do you want to put in 750 extra? Because that is, again, that's something that you want for free. You want, first of all, you want to invest at the same valuation. You want to have an option also. So it's a call for you guys.
Well, it's not a call, it's just meeting the milestones that you have put forward yourself. That's what you expect to receive. That's what you told us.
Yeah, but I only want 750, so I don't need the other 750.
Well, I think that that is plausible, but highly unlikely.
So let's see. For me, really, it's. My prerequisite here is that if you want to put in more money, should be at a higher valuation. And if we make this company profitable and we meet the milestones, the valuation is completely different than it is today.
Well, I think you sell us into the milestones.
Yeah.
We look into the future. That's how we arrive at the valuation today, right? So I think, first of all, 750 is not really an A round that you're asking. It's really a seed round. And Ravenous is not a seed investor. We are A investor, having US partners looking for A rounds also in Europe. So we would need a certain ownership. So we are driving towards a certain ownership. And we already felt that the valuation was already a markup of 2.4 times what you did 2 months ago.
No.
3
Something
months.
like that, yeah.
So we felt that was quite generous.
Okay.
And also, it's given our experience, and we've been investing in a lot of companies, of course, is that it usually takes more time and it costs more money.
Yeah.
So in a way, the worst scenario you as an entrepreneur can be in is, of course, running out of money.
Yep.
Because then you're going to be in a very tight negotiation point of view. So we just want to make this clear. You put forward some milestones.
Yep.
And we said, okay, we're using our investment in order to get to those milestones. So, let's make sure we also have a mechanism for adding more financing to get us through to a B round.
Okay, but to be honest, I'm not interested in this kind of milestone. So either you invest now, you take the risk with us, we share it, or we don't do any milestone, or we do a higher valuation. So that's kind of my prerequisite here.
We can probably remove the milestones and look at the valuation again.
Yeah, that I feel.
Down.
Then we have to look at the price, No, but anyhow, so I think, I can agree with you that, always take the money that's on the table. If we are honest here, I can agree with that one. So if you want to, then by the way, I don't know who the second investor is, so I have no clue. So that's one I want to know as well in advance.
We usually have a carve out for good angels. We are not based here in Helsinki, so.
Yeah, but I need to know that before we sign. I want to know exactly who that is.
That's a carve out. If a good angel that you don't agree with is not picking it up, we'll just pick it up.
Yeah. Okay, so you mean that you will give me also a kind of a consent for that?
Yeah, I mean, we need to agree on the
Good,
guy.
good. That's okay for me. So we agree on no milestones. We agree on a high evaluation.
No, we didn't agree on a high valuation. We agreed on a no milestone at a low valuation. We take more risk.
Okay, so then we go back to the 750 again, you know?
750 is too low.
No, that's, you know, then I will take the risk. You want, you know,
No,
you
I'm
will have the
taking the
option
risk.
to invest at a later stage.
Well, you always have options, but I mean, we want to reach a certain stake in the company, and I think it's only fair that we have enough runway so you can raise your B round. Even though you say it's going to take longer time, I think it will be taking some time to get there. We usually times it by 2.
And it's not only you taking the risk, because we don't want to be out fundraising too soon. I mean, we want you to concentrate and building the business on reaching this milestone.
And I agree on that. But in my view, the 750 is enough for that. So that will take us to profitability. And I'm ready to take that risk, but I'm not ready to commit the company to certain milestone, build up a cost base, and then in the end be forced to take some money at, you know, at a price which is not good for me. I think we can build a lot of value already with the existing 750 that, you know, will benefit all of the existing shareholders as well.
So what is the number you think that is enough to be comfortable on the safe side for getting to the B round with a good scenario up round for all of us, which we all want to achieve, right? What's the number?
Let's say, if you want to take some, I mean, for me, 750 will take me to profitability.
Yeah, and I say we don't believe that. So, I mean, we need to find a compromise, no?
Yeah, but anyhow, I think we agree here. I think we agree here. As long as the evaluation mechanism is the same, you know, if we take 1 million from you guys, it's the same 20%. That's how the logic works.
I don't think so.
1 million and a pre of.
And I think it's clear that if the company needs more money, you are the first investors whose door we would come knocking, and then we can either agree on the valuation of that additional financing or not.
The witness is speaking. Not allowed.
Come on. So what's the issue here?
So the issue is that 750 we don't believe. Let's the carve out we had for the angel investors.
Yeah.
We can remove that, and then we can land a compromise somewhere between 25 and 30% ownership for 1.2.
It depends on the entire package here where we reach. I mean, I'm kind of I'm more concerned about the entire package here than the valuation, really, to be honest.
So what are the things we need to discuss? If we say that it's almost 30% for 1.2, what if we could agree on that? What would that take for the other terms?
So let's take them one by one when we get to there. But you know, we can discuss.
So in principle, we agree on the 1.2, 30%, and then we look at the other terms.
So what will that give us as a pre 1.2?
I haven't calculated that because that depends on
It's
the other terms.
Nice uptick to for you and the angels.
25.
Horse trading, 27.5.
25.
No. Sorry.
So we agreed on that
we agreed to remove the milestone. There's no milestones.
to 1.2.
We agree that it's 1.2.
Upfront 1.2.
Yep.
Higher risk.
Upfront, exactly. We agree that.
Valuation.
And higher valuation. Okay. So we can
1.2 gives us 27.5%.
Yeah. Okay. We can agree on that.
Okay. Should we sign?
No. As I said to you, it all depends on the details here.
God
Because
damn it.
on all the carve-outs that you have made here, and
Okay.
the rest of the agreement as well.
Let's walk
Okay,
through them.
I'm going to step in. That was really interesting. One thing that Jimmy mentioned is that this is really more of a seed round
Yep.
and I'm just curious from the VCs, what is the difference between a quote seed round and first round funding? Can you define the difference?
I mean, there's no set definition as such. It could be the size of round, it could be the stage of the company, It could be, I mean, oftentimes it's connected to such a round valuation and the terms that comes with it, I think. I think if you move back 10 years ago, it's probably easier to make the distinction. Typically, VC would do the A-round investment. But nowadays, with VCs, going really early stage and doing seed investments and stuff, it's also been blurred quite a bit, I think.
But I think the argument that 750 is an A round is a stretch. I think usually as a VC you would expect, up to maybe 750, maybe even $1 million is kind of closer to a seed round just in size. And asking for an A round of 750 is unusually low, I would say. It's usually, 1.5, 2 million.
We define it that up to $1 million is a seed round, for example. Yeah. But it is not set in stone.
1.5 to 3 is usually.
And do your funds participate in those kinds of rounds?
Yes.
Yes.
And I guess the follow-up are you seeing more VC funds participating in seed rounds today than, say, 2 or 3 years ago?
I think that's the case. I think Sunstone in particular, we have a dedicated seed program out of the most recent fund where we can do a certain number of seed investments where we only need 2 partners to agree and we can sign a term sheet on the spot if we're 2. So Daniel and myself here could sign a term sheet. But I think mostly what we do is, of course, A rounds. So seed rounds for us is usually 500 to 750, but I think other funds, Crandom also do seed, right? And you have also a number of the London funds, even the bigger funds that also Index, for instance, would be doing seed. And so I think also locally here some seed funds.
Okay, nice job both sides. We're going to go to the next point, which is what kind of security is this?
Okay, so liquidation preference. I think we had some major concerns there as well.
Yeah. So, first of all, I just wanted to make sure now that we're on the same table here, are we?
No, you're on this table, we're on this one. I'm just calculating the valuation.
Yeah, me too. I already done that, so take your time.
Yeah.
So regarding the liquidation preference, what's your logic behind that one? I mean, we never accepted that. So just to understand you're VC, venture capitalist. You want to take risk, or you should. That's what your logic is.
Yes, and we're taking a big risk here, of course. So the liquidation preference is very much in order to put incentives in place for you as founders to create a big enough company. So we want it to be painful to sell early.
Okay. That's a new argument.
That was a good argument, actually.
I mean, as you know, if we would have a lower exit offering, that might be attractive for you, but could still be in a situation where we either lose our money or just get the money back, and you get still decently rich. And we want to avoid that. We want to make sure that you really push for the big exit, and if we reach that big exit, if there's a 2x liquidation preference or not, it will have a minor impact on your returns.
Also, I mean, we at the end of the day, what we want to achieve is a minimum return.
Yeah.
Right. I mean, we can go in and make a lot of small A rounds and have no return. I mean, we just want to guarantee our investors that we at least generate a minimum return. So, if it's a very big exit, I think this part is not really that relevant, and we are aiming for the big exit. So.
But I do have done my simulations here, so at an exit 5 times, probably.
We're not looking for 5 times, then we leave straight away.
Yeah, okay. But let's say
it's
it's 5 times or 10 times. I mean, that will eat up your.
What's your expected exit value?
Huh?
What's your expected exit value? Where would you sell?
Let's make sure that it's a win-win solution where
No, but where's the exit? What's the target exit? Where would you be happy?
300-400 million.
Then it's not a problem.
It is.
It's
because
insignificant.
But the problem
it's a
is
couple
not
of million.
The
It's
problem.
a couple of million.
No. But the problem with the liquidation preference is basically it's in the whole psychology of the liquidation preference is that you don't take any downside risk.
That's right. We don't.
Yeah.
If the company goes belly up, we're
It's 0.6% at your 400.
Yeah. But
Is that
you
the
don't
most
take any
important-
downside risk.
Is that the most important thing you have for the term sheet?
No,
or-
no, 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 no. But
Okay.
let's take them
Let's
one
focus
by
on the
one.
important things then.
No, 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 no. So, okay, if that's not important for you, let's take it away then.
So the more than 50% of the companies will go bankrupt, right? So there's big risk in here. So we want to make sure in the ones that don't go bankrupt that we're getting enough of a exit multiple on it.
Okay, but you don't need 2 times the money for that. So let's make sure that
We
you
want to
get
have
your money back.
at least 3, and we're aiming for at least 10.
Yeah, but let's make sure that you get your money back. You don't take any downside risk.
Minimum 3x return is also 10.
I've never seen those, but 1 is okay for me. If we agree on that one, we can go forward. If not, then this one, we can't agree on this one.
Yeah, I think with 1x means that after you have gotten your money back, after that there should be full catch up for the founders. So the founders should get exactly the same euro amount per share after you have get your preference first. So basically everybody should be treated similarly except at the very low valuations.
Sorry, we were just discussing.
Yeah.
Okay, so I was
We didn't hear you, by the way, because
okay,
you're supposed to be silent.
Yeah, so I can repeat that with
Yeah, sorry.
1x Mikke was meaning by that first you would get your original investment back, and then the founders or the other shareholders would have full catch up, so they would receive exactly the same euro amount per share than you have got first, and then everything would be distributed pro rata, so in the
But
same
that doesn't
proportions
guarantee
that
us a
they own
minimum
share.
return, right? That's just a downside protection.
It's a
That
downside,
would be just
exactly.
that downside protection, yes.
As we said, we need a minimum return, right?
Yeah, but now you will, that you have with your shareholdings. So with a good exit, we're not giving you downside protection. That's not, if we're giving you 1x, that's enough. That's the way, it is.
I mean, 2x with the structure that we put in place gives you a decent minimum return. If you take it to 1x with a catch-up, it doesn't give you a minimum return.
But don't you think that founders would also get some return for the work that they have put in the company?
But how
in
much
case
have
of
they
exit?
put in the company?
Well, now they have put 1 year of their time, and by the exit, several years of their time.
That's a good hourly rate.
Does everybody understand what catch-up is here?
I think we'll get to that, Brad.
Okay.
So maybe
There's
we just
another
briefly
one.
discussed maybe 2x. We can live with the 2x since we did a decent compromise on the valuation side. So maybe 1x, but with the participating preferred. So that comes down to 0.3% at the 400 million exit. That's
then
decent.
we do a kick-out. So basically, at a certain, at certain exit value, basically, you don't get any liquidation preference.
We don't get any liquidation preference.
So you want to introduce
So
this
that's
as
un-
well?
that's
you're not,
unusual.
you're not getting the first hand,
We have never done that, actually. Have we done that before?
Huh?
Have we ever done that?
No. This is plain vanilla standard term sheet. So basically you want to introduce sort of a dead zone where there's only benefit for free size. So how is that good alignment?
So basically, that would basically, give you the downside protection you're looking for, and then you will go,
We were looking for minimum return, not
You're
downside
basically
protection.
creating some exit values between we don't get any more upside. There's no incentives for us to push for a higher exit. And how can there be?
Of course, but it will be, it will be just, fractions, as you talked about. It was only a couple of percentage.
But I think we could stick to the 1x, but with the participating preferred instead of the 2x. I think we could get that through also in the partnership back home. But we have never done it with a full catch-up for founders, ever. So that's not going to fly.
So you want to have full participation rights?
Sure. So it's a 1x. We get the 1.2 at your 400 million exit, and
It's very standard for
it's pretty
for an
standard.
A-round.
Yeah, definitely at least in the Finnish market, and what we have also seen in the Finnish market when foreign VCs have invested in Finland. This is
We
not
invest
market
all over the
practice.
world, and this
It
is
would
pretty
be
standard. I mean,
highly
it's-
unusual to have 2 times liquidation preference with participation rights.
It's not going to fly in our partnership. Sorry.
And that's why we bring it down from 2x to 1x, since Finland seems to be so peculiar when it comes to this matter.
Yes.
1x with full catch-up, because
Yeah,
full
otherwise it's
participation.
not fair.
If we would be doing a seed investment,
Let's look at the other terms. Let's leave this one. I mean, the catch-up is, is pretty normal. So, catch-up, full
Well,
catch-up, and then after that.
not where we come from.
And then we can look at this at a later stage, because this gives you an X amount of percentages more, and I think that's not fair in terms of the whole deal structure.
Okay, I'm going to cut in here, and maybe I'll ask Kimmo, can you describe in 30 seconds what participating preferred is and this whole 1x cap? Can you just say, okay, this is how it works out in the real world?
Yes, well, first the liquidation preference, 1 times or 2 times liquidation preference means that the investors get their investment back either once or twice, and sometimes they may also get some annual interest on that investment. Then if they have also participation rights, it would mean that after the investors have gotten their investment back either twice or once, then they would share pro rata in all remaining profits, and so meaning that they would get their ownership percentage of the remaining proceeds along with the other shareholders. Whereas if they would have liquidation preference and non-participation rights, then they would just get their investment back either once or twice, and then they would not get anything after that. So then basically they could choose that whether it makes more sense for them to get their investment back either once or twice, or whether it makes more sense for them to give up their liquidation preference and be treated similarly with all other shareholders, so just to get the ownership percentage of the proceeds.
2 points, I think. First of all, even 1x participating preferred shareholder structures, even in the US right now, is not customary anymore. I think it's fairly normal to have a catch-up. So I think this is a pretty hefty one, and the argument that the VC should say that it's customary to their partnership is of course completely bullshit.
Yep.
Right? There's never such thing, right? If you want the deal, you figure out, you negotiate, right? It's another part of discussing the valuation.
Yep.
It's just valuation.
So you're giving up the dividend as well now?
Yeah, we forgot to bring it in actually.
Yeah.
Are we role-playing now?
It's taking
That's sneaky. That's sneaky.
I mean, there's another aspect of the liquidation preference which could be interesting, especially from a founder perspective, but also from an early-stage investor. Typically, what you bring into term sheet or eventually an investment agreement will continue. So if we would bring in a 2x participation, full participation, it's a little bit like when you're peeing in your pants, right? It feels good at the moment, but then we have the follow-on investors who are going to say, "Whoa, you guys had a 2x. We're going to have a 2x. We're going to have that on top. So you get super squeezed, we get semi-squeezed." So I think that's something that VCs have experienced and also having.
If you have your Series D or F round and you have raised a lot of money and come nowhere, then the last money coming in, of course, will try to invent these things to protect their interest in the end. But in the first round, it doesn't even help the VC, to be honest. Yeah.
But what you have to remember as well is, all of these things that you give away now, you will never get back. So what it's all about is negotiation power also for the next round.
Negotiate in the first round, seed and A, negotiate on the price. Negotiate, and maybe VCs want the downside protection for fiduciary responsibilities to the LPs, the investors. But aside of that, I mean, go negotiate on the price.
I agree, 100%.
Yeah.
And the price is not the valuation, and that's, I think it's really a key point here.
Keep it simple.
Yeah, and obviously.
One thing I'll add, I do a little research on what's happening in the Silicon Valley, because there's a lot of data, there's a lot of deals, and when you start getting into Series D, E, F, you get a couple things happening. Usually the last money in is the first money out, because at that point the company's burning through cash. And that's where you're starting to see the reemergence of the 1 to 2 or even 3x liquidation preferences. Senior liquidation preferences are happening in 34% of the deals in the Silicon Valley in the last quarter. And of those, what's happening just in the last 3 or 4 months is you're starting to see a greater percentage of more than 1x. The research I did showed 57% of the senior liquidation preference deals are in the 1 to 2x range, 29% are in the 2 to 3x, and 14% are 3x or more. So think about that. If it's a company, maybe they've raised 100 million already, and now they're doing a $20 million round. Some of these deals are getting pretty hairy. I'm just curious, what are you seeing over here in Europe? Is that?
First of all, it's cyclical.
Yeah.
It's very cyclical. So the harder the times and the fewer the VC funds, the higher the price, right? And so liquidation preferences. But I would say right now it's fairly customary. It's 1x with some kind of catch-up structure.
Or
downside protection
yeah,
structure.
and I would say for C deals, we see almost exclusively 1x non-participating, which is another version of getting some downside protection, get your money back, but then of course forfeiting that if you want to have the pro rata.
Yeah, I would also say that that's in my experience the market practice in Finland, that in most cases, even in A round, the founders have to accept that one-time liquidation preference, but then it's non-participating.
We had a C round maybe a year ago, and they were proposing 3x liquidation preference. Yeah, we told them to fuck off. Yeah.
I think one point to make is that obviously it's also in the investors' interest that founders are properly incentivized, and especially after, let's say, C round, if there are too hefty liquidation preferences, and the founders can calculate that, let's say, first 30 million or 20 million of the exit proceeds would go to the investors, probably some of the founders would give up at that point.
Okay, we're going to move to the next one. Before we get into it, though, I would be interested in how many of you in the crowd here consider yourself to be entrepreneurs or founders? Okay, most of the crowd here. So this next point is one that you should find pretty interesting, because first you take the risk of quitting your job, starting the company, getting it going, get some traction. Now you're in a real discussion with real VCs. You've already got yourself in a rarefied company, and you're feeling like, God, I've really achieved something. And then along comes this provision. Back to you guys.
Yeah. So let me start off by saying that I like this clause. You know why?
Yes.
It makes me feel comfortable as well.
We are happy you say that.
But of course, you know, what I want to get out of this is to make it fair. So, you know, I put down, 1 year of work before, incorporating, then 1 year, and you're asking my employees to, to commit to a 1 year cliff and then 4 years, in total. And you're saying to me that basically I have to start from zero again. So my point coming back to this, first of all, I would like to introduce something, good leaver, bad leaver provisions here, because that protects me as a founder as well. So if somebody fucks me up, then I can basically redeem their shares. We'll get to that point sooner as well. So if that's okay for you guys, I would like to introduce that one as well here into this one.
That's okay. Good leavers when you die, right?
Huh?
I mean, legally, that's completely stupid, but it is a good leaver scenario. So we can include that.
That's one of the
We can discuss details about that.
Lawyers have a funny way of having humor.
But we're happy that you like this clause, because as you quite rightly point out, this is very much in the interest of founders as well. I mean, Mickey, we really love you and the team, of course. We invest in you guys. We know it takes time to build this 3-4 million euro, 100 million euro company. And of course, it's not in a case scenario where you sort of leave in a too early
Did you get my
stage
point here?
Yes. So I'm reiterating that.
I'm basically saying that everything vests for me.
We love this clause, and then you want to introduce the good and bad leaver clause, right?
Yeah, basically. So basically, if you fire me, I keep all the shares. So that's a good leaver, bad leaver thing. I vest all my shares.
Let's try to take that scenario a little bit more. So why would we fire you?
If you fire me for some reason.
There could be many reasons why we fire you.
Yeah. But if you fire me, then I'm a good leaver. If I leave you in shit.
Not necessarily.
But if I leave you in shit, if I leave the company, then, I'm treated like a bad leaver.
Okay, you go on vacation in Bahamas for like 6 months, and we fire you, and you're a good leaver. Give me a break.
Okay, but we can make those work. That's
So
why
there
I
are
have the lawyer
carve-outs.
here. But
There are
we agree.
carve-outs.
But we agree on that one. But then I'm breaking my employment contract, and that's a different thing.
We haven't done due diligence on your employment contract yet.
Yeah, if I can
But we
say-
have taken your criminal record. It didn't look good.
So basically, we agree on that we introduce good liver, bad liver provisions here.
Yes.
Good, that we can agree on. Then the question is how much of my shares are vesting up front?
None.
What I'm saying here, if I give you good liver, bad liver provisions, I have to get at least 75, 50%.
We're giving you good and bad liver provision.
What do you mean?
You asked for if we gave.
That's not correct. They own all the
We own all
the
shares.
shares
It's
now,
all
and
vested.
there are no this kind of reverse vesting provisions in their current shareholders agreement. So now they are kind of giving their shares back to you, and then they may get some
But
of
the
them
angel
back.
investor didn't pay any high valuation for it, so of course they wouldn't have that.
So what I give you the comfort with a good liver, bad liver, you give me 50% at least vested up front.
Not
Because I have
50%.
100% today.
Not 50%.
Why should I give you 50% back? Why should I give you at least any shares?
Because we invest in your business and your team. And
Yes.
if you're not around,
If
someone
we don't
else needs
perform-
to do the job, and they need to have some upside.
Yeah.
If you're not there, we need to give that upside to someone else. That's why.
Exactly. So if I leave, you get the shares.
Yeah, exactly.
And
We
that's
get
a
the
good
shares.
liver, bad liver idea. So, basically the shares are vested and then we have good liver, bad liver provisions. That's enough.
But we're talking about how much you would already have vested.
100% today.
Yeah, today, 100%.
Yeah.
Today you don't have our investment.
That's a good point.
Okay.
So yes, we're
But-
willing to introduce the good bad lever, but it will be that you sort of put in all your shares.
But they have already spent, as we discussed, more than 1 year of their life for these companies. So wouldn't it be totally unfair that even if they would leave voluntarily, why should they lose all the shares?
If they are not here, we wouldn't even be having this discussion.
Okay.
If they are leaving,
Sure.
we will not be investing. If the signal here is that you will be thinking about leaving, we'll not be making this investment at all. So you need to give us some guarantee that you will stick around at least the 4 years that we suggest.
Yeah,
we can't discuss if we can maybe reduce that a little bit, but you need to hand over all your shares if you leave.
Okay, so how much?
Everything.
You said you can.
We can. I think we.
I mean, this is.
Maybe we can work on the cliff. Maybe we can do that 50% after 1 year.
Yeah, 50 is okay. Thanks, guys.
So what we could do is, instead of giving you the 1 year and that's up front, we could see the vesting with 3 years.
That's okay, as long as we have the good liver, bad liver, because that's for your comfort, that's for my comfort.
Yes.
So can we also discuss a bit more about the good liver, bad liver terms and whether we are on the same page with that? Because, now this says that if the founders leave, you would be, or whomever.
Why don't we discuss those in the shareholders agreement? I mean, this.
For the founders, this is probably one of the most important provisions of this term sheet.
I thought the valuation was the biggest.
Well, certainly valuation is, but this is the way how the founders get to realize their valuation, to be able to sell.
But they stick around. They stick around.
We agree on that. We're trying to build a big company, right? And that takes time.
Sure.
So we're getting a little bit uncomfortable here. Why the founders are so hung up on leaving early?
I can agree with you here. I can totally agree with you here. As long as these provisions, prevail for everybody. I mean, this is the comfort for the entire company. Here, I would, argue for your sake.
Also for your co-founders,
Yeah,
it's in your best interest.
Yeah, exactly. That's here I would argue exactly.
Okay, but just to make clear, because I'm also representing the other founders, and just that you're clear. Do we all agree that
Standard good lever, bad lever scenario.
standard good liver, bad
Standard.
liver?
We put that in the term sheet.
Okay,
Standard
okay.
good lever, bad lever.
Okay, and so if there's good liver scenario, then those shares that would be bought back, they would be bought back
Good lever
at
if
fair valuation.
Mika dies, of course, it's a good lever, no?
Yeah,
Standard.
and if you would fire him without valid reasons.
So
Yeah,
when
okay, fair enough.
When you're saying standard good leaver, bad leaver provisions,
Yes.
I would argue that, what you're looking for here is something that only the vested shares. What I'm saying here is that if I'm a good leaver, I will keep all my shares. So they vest immediately.
That's what we would consider standard.
That I've
Is that
never
standard?
seen.
Is that standard?
Scout sonar.
That's how I see it.
I've never seen that.
No, that's how I see it. Otherwise, we have back to the square one.
That's unusual.
Okay, so then we're back to square one, so 4 years.
So 50-50. But I think the good leaver, bad leaver is something you want to have. And what we want to
You
have
suggested
instead,
it.
what we want to have instead of that is that if you're a good leaver, you keep your shares. That you basically all of them, even the unvested shares. That's fair.
Then I think we should have a good lever, no cost lever, and bad lever scenarios, and then we should have different schedules for the different ones if you really want to go into the details.
Yeah, we can do that.
That's also possible. And then I have one more
Do you want to
note.
discuss that at the term sheet level, or?
We can take that later.
Okay.
Yeah. Then I have one more note regarding the term sheet. Now this says that if this buyback situation realized, it would be primarily company and secondarily the investors who would have this buyback right. And obviously the company can only buy back its shares if it has distributable profits. And most likely in this kind of scenario, it doesn't have distributable profits. So then it would be basically you who would be able to buy back those shares, and in bad lever situations, basically for nominal values. So we certainly don't think that that is fair. So it can be primarily the company, but secondarily it has to be all shareholders who could buy back those non-vested shares at bad lever situations.
But we're
at
coming
cost.
back to that at a later stage, I think, as well. Because I think here we should treat everybody equal.
Yeah.
Yeah, we don't agree with that, but should we have that now, or?
We can take that
Yeah,
at a later stage.
Couple things I'm going to cut in. This is obviously something that's near and dear to the founders' hearts, which is the value of their own shares and how much risk they have. There's tax issues. There's all kinds of things. I have a question with respect to good lever, bad lever. First of all, Jimmy mentioned a couple times that dying makes you a good lever. Maybe not. What if you commit suicide? But the second one is, what if the company gets acquired? And there's provisions in these where, let's say, the company gets acquired after year 2, not all of the shares have vested. Does that accelerate 100%, or do they have to go work for the acquiring company in order to get full value? I'm just curious how you guys have dealt with that in the past.
Full acceleration.
So yeah, that's the usual question. That is, if the exit happens before the usually 3 to 4 years, which is, I think, standard. The question is, do you have acceleration like 100% at the exit? Or do you have what you call double triggers, where you accelerate like 75 or 80%, and then only after a year with the new employer or the acquirer of the company, you get the last 20-25%. And frankly speaking, Sunstone would, in most cases, argue for the double trigger, so there's not full acceleration investing. And the reason is that this is always going to be a discussion with the acquirer, and it's basically more than its terms that we want to enforce. It's basically having the discussion at the term sheet level, so you founders of companies understand that that discussion is being reopened anyway at the point of exit. So the matter of the fact is that the acquirer doesn't really care about the VC, but cares about the founders, because they are the continuing party in the partnership that will be going on. The company will go on, right? Just with another set of owners. So of course that box is always going to be opened anyway.
And it's, I guess, especially the case where you have acqui-hires. I mean, acquiring the teams, and that's the asset. It's oftentimes not cash only, so there's share swaps. So in those scenarios specifically, I think this is quite important for the VC.
We have an exit process right now. I actually came out of a meeting just before we entered here, and it's a US listed company that's acquiring a company, and there we have exactly this discussion. Actually, just before we entered this room, we had this discussion, and there we have double trigger acceleration, but that's not enough for the acquirer. So now we need to go in and define RSU schedules, which is restricted stock units under NASDAQ SEC rulings and so on. And you have that whole box opened again. And then you have, in many respects, again, the founders and the VCs sitting on a little bit different sides of the table again, which is best to take it up front when you sit on different, but then you are more united towards the acquirer in the end, right? Aligning incentives. So, but this will always be open.
I've seen it work where there's almost a perverse incentive to try and get fired by the acquiring company, because that would trigger the good lever, because maybe they didn't get fired for the right reason. It's an interesting one. I'll take this offline. We'll go to the next one, but these provisions are worth looking at pretty carefully, in my experience. So. Next up, we're going to talk about another thing that I think might be surprising to some of the founders when they find out that maybe they're personally at risk with respect to what they've told the investors in the deal docs.
Yeah. I think this is pretty straightforward.
Well, yeah, I guess the contents of the representations and warranties, that's pretty straightforward, and obviously we haven't seen that schedule yet, but we assume those to be quite straightforward. I think our concern is that you have also written here that the founders would give some representations and warranties, and we were wondering, would that also mean that if those representations and warranties would not be correct, then the founders would also be personally liable for the damage that you would suffer? Yes? Okay, so then we clearly have a problem. Obviously, the idea of the founders when practicing business in limited liability company is that they won't have any personal liabilities. And now you are saying that, let's say the founders represent that, for example, that the company's technology doesn't infringe any third-party intellectual property rights. And then if it later happens that there is, for example, some patent that they are infringing that they weren't even aware of, then company would suffer some damage and the founders would compensate that damage to you from their personal money, which would be really unreasonable.
We can probably put in some knowledge qualifiers, right?
So let me just ask you on this one as well. Is this clause here due to your laziness of not doing a proper due diligence?
No,
or is it for real?
This is standard reps and warrants is quite normal, and I think what we're trying to really invite you to do is tell us the truth before we invest.
Yeah, we've already done that.
And the reps and warrants.
Then you have nothing to worry about.
No, not really.
So everything that is basically in the data room is kind of carved out from this one?
What if you omit something in the data room?
So I mean, that's up to you. You have full access to the data room.
But we don't know what you didn't put in.
Huh?
We don't know what you didn't put into the data room.
Yeah, but that is
What
separate.
you
That's
omitted.
That's a separate question. Huh?
Yeah. We will put in the data room whatever documents you want to see there. And then you are requesting us to pay 25,000 of your legal costs. I would assume most of that goes into due diligence. So your lawyers will do a careful job of going through those.
It's going to expensive lawyers that are drafting legal contracts.
So basically, anything that's disclosed in the data room is not covered by this. So there is no personal liability on anything that's disclosed in the data room.
If it's disclosed in the data room, I think we can find some more standard clause for that.
Good. And then
But of course, there will be more standard reps and warrants of saying that you have actually put everything into the data room and you haven't omitted anything, you haven't stolen, you haven't lied, you haven't,
of course,
all these things.
The other thing is, from my point of view,
But that's personal liable if you do that, just so we're clear.
And by personal liability, I assume that would be capped to some reasonable amount. Obviously, it would bankrupt probably at least most of the founders if they would have to pay, let's say, 200,000 euros.
Our investment plus some interest, I would say.
So I would say this way, I mean, you're going to be on the board, you're going to have full access to information, you have full access to the data room. Let's put a cap on the time instead, because we are confident that we've disclosed all the information to you guys. So first of all, I want to have that carved out. The second one, I want to have a material breach carved out. And third thing I want to have is a time cap on this
material breach on whose side?
So what I mean is basically is if I do, I mean that is I'm liable if I do a material breach towards you, if I tell something that's not true. I mean that's okay for me. I can take that liability then. But anything else basically which is not material breach, which is not in data room, or which is in the data room, or which is outside of a certain time period of let's say 6 months, that basically not be personal liability.
Yeah, and also the founders would only be liable if they have basically knowingly not disclosed something to you which they should have disclosed. So not if something happens that they are not aware of, they should not be personally liable. They can't take that.
So
kind.
to their knowledge,
insurance company, they can't take
to their
that kind of
knowledge,
risk. That would qualify all representations and warranties.
Similarly, that you expect us to have then looked at the material and sort of say that there's a carve out. Of course, we would assume that there are certain things which are, relevant for you guys to have known. I mean, it's not just that, whoa, I didn't know that. There are certain things.
So like what? Give me an example.
It could be that could be entitlements of shares. There could be venture. There could be technology sort of infringement. Having made trademark checks, pretty straightforward things, for example.
So I would suggest that whatever you mean like that, you put that into a list, a separate list, and then we agree on that list separately because that's a written list and separate.
Yeah, we will bring a standard reps and warranty schedule.
Yeah. Well,
like 30 pages or so.
Yeah.
How many pages will that be?
30.
30.
Yeah, we can usually end up 25.
Okay,
we'll see.
Given the makeup of the audience here, I guess the next question, what is market? In my experience on the West Coast in the US, this is highly unusual to have founders personally rep and warrant. I mean, it sounds like it's pretty standard over here in Scandinavia. Is that right?
Yeah, that's right.
Yeah.
With a cap, usually. As suggested by the attorney of the counterparty.
Yeah, I would say that normally the founder's personal liability, it's capped to, I don't know, something between perhaps 50,000 or 100,000 euros. So some amount which would not bankrupt them, but which on the other hand would be enough to
a nice
incentivize
car
them to
or
be
a small
fruitful.
flat.
What's that?
A nice car or a small flat. It has to hurt a little bit.
Okay, we're about halfway through the program now, so people, if you want to stretch, feel free to do that.
One thing, Brett, on reps and warranties, this is what have struck me a lot of times is that you negotiate the term sheet fairly detailed. And then it says 2 sentences that says standard representation and warranties. And you spend, as founders, most of the time on all the other things. And then when you get to the shareholders agreement, there's a full schedule of, it's not even a joke, it's like 25 pages, right? That suddenly keeps you liable and all these crazy things that usually is completely unexpected unless the attorney, of course, have informed of that. And then you have really, you were at a good mood, also in the negotiation, and suddenly you feel like you have to reopen the whole box again. It's really mentally a strange process. And it's, in most cases, a surprise for founders. And it's hurting the relationship in the end. So I think both for VCs and founders, it's good to spend a little bit more time so you don't get surprised there in the end. And it usually comes right at the end because that's where the VC have done most of the due diligence and know what questions to ask. So I think that's also for the attorneys. There's a little bit, educational that there will be stuff there.
Yeah, absolutely.
But it goes back to the whole basic principle of, how you act is basically no surprises. So if I am as a founder feel confident with that there are no surprises, most of these, are pretty rational ones. So if I can get a time gap on those or a cap on those, if I can get some kind of personal liability drawn down, if I can have, the material breach stuff in there, and if I'm, I feel comfortable that I've disclosed most of the things, then that shouldn't be a problem. But it's turned out to be a problem for quite a few people.
Yeah, but it's a mental process that's a problem. It's
exactly.
not really the problem because, of course, people on average don't steal and lie and all these good things. But it surprises people also when you start to talk about personal liability. You can see yourself coming home to, wife, girlfriend, friend, whatever, and steal away the house, and you sort of envision all these bad things that can happen, right?
Has that ever happened to you guys?
What happened?
On the reps and warranties, have you ever, gone after the founders? Has this been an issue for you guys?
Never.
Never.
But it's also a bit of a stress test. I mean, as you say, we should know all these things, right? But we don't. I mean, when we invest, we're at the pretty big information disadvantage, of course, towards the founders. And it's in no one's interest to have too lengthy due diligence processes. Cost time. I mean, it's a big cost and a time component. We just raised money from a private equity firm, and I mean, they spent probably $1.5 million on due diligence. I mean, you can't do that early stage. So this is a way for the VC to test also the entrepreneurs and feel, are you really revealing everything now? And sort of a compromise of not having to go into this humongous due diligence processes.
The trade-off is usually if it's a short process and it's smaller amounts, you tend to go quick and do less due diligence and more reps and warranties. As it matures, round gets larger, more due diligence, also on the VC side, lower reps and warranties. So the earlier it is, the more is handled with reps and warranties and VCs that haven't done their homework, and then putting the risk to the founders a little bit. It's a trade-off.
Okay, so this is where we, I'm sorry. One more, what's that? We're not quite at the halfway point. Do you guys want to talk about this?
Yeah, we don't want to see that one as well. I think.
Not this one either.
I love this one.
I don't think this exists.
Full
Or does it exist? It's only in your minds.
No, we're in this very specific country that we're at, it's standard.
So it's a full ratchet. Okay, so what's the logic behind it? So you want to come on into our company. You want to invest. You want to co-decisions. You want to be on the board, and you want to, of course, beef up the the costs, and then when time comes, you want to take all the shares.
But it's fairly simple, actually. It's a very simple principle. It's kind of anti-rust guarantee.
What?
Rust guarantee. So you want to sell us a Volkswagen. But if we later figure out that it's only a rusty Skoda, we don't want to pay for a Volkswagen.
So basically, you are not taking any risk regarding the valuation.
I mean, you come in and sell us a perspective of 400 million euros.
Okay, so here, I think I understand what you're coming from. I understand what logic is here. But once again, I think this is due to your laziness, as I view it. What I would like to have here is it's kind of a downside protection for you guys for a certain time period. And that's otherwise this is off the table. Ratchet, anything like anything comes to anti-dilution. First of all, it's really complicated. Second of all, it's
full ratchet is much more easy than the weighted average.
That's a one, yeah.
Yes.
Anything else is really complicated, and I think time protected, reasonable time protected could work. So like 6 to 9 months, you have the reasonable time to.
When is the next round? There's not even going to be a next round in 6 to 9 months. Then you need to fundraise now for the B round.
Let's say this way, I'm not even going into a negotiation about anti-dilution. So.
Okay. What?
So if you want downside protection, I can give you that for a certain time, but going into like a full ratchet negotiation, so anything like that.
But it's okay
what
to time limit.
What protection would give us? what is the downside
We can
protection
agree
you're wearing?
on a mechanism where basically for 6 to 9 months you will have downside protection of some kind. For example, that
What would trigger it?
let's say, for example, that you could block a new financing for a certain period of time at a lower valuation. That would work, for example.
We
or
already
an
have that
exit.
in protected provisions.
Well, but we haven't accepted that yet.
Yeah, we haven't come to those yet.
Okay,
That I can accept, but
We'll come to that.
any anti-dilution clauses is off the table.
But I mean, there's not going to be a new round, so there's not going to be a valuation discussion. Of course, the next round is going to be when we see if you sold us a nice car or a rusty car.
No. This round has a price, and that's what you're participating. It's not next round that you're participating. This is this round that you're participating, and this round has a price.
We pay
You're not getting a protection for next round.
We pay 2.5 times up.
Yeah, but you're not
We're
getting a
paying-
protection
we're
for
paying
next round.
We're actually paying for anticipated growth and expansion, right? So I mean, if we go back to what is the company worth today, we could start applying some fundamental valuation principles. The company would be worth much less than what we are agreeing on here.
But you already have your liquidation preference. In my view, that's good enough. You have your downside protection. You get your money back.
Yeah, and also what this full ratchet would means, it would really, if it would be triggered, obviously it depends on the valuation of the dilutive round or the down round, but if the down round is at much lower valuation, it would really dilute the founders so heavily that they wouldn't really have incentives to work for the company anymore. So it's not really in your interest either. And obviously we also know that if you have now anti-dilution protection, also the subsequent investors want to have anti-dilution protections, and then it's really a
You're opening
mess.
up a can
Okay,
of worms.
I'm going to cut in. First of all, how many here knows, how many people in the audience know what a full ratchet is?
That's one.
Okay, does it sound kind of nasty?
See, nobody has that.
I think it
Haven't
does.
signed any deals.
It is like a hatchet or a ratchet, but in a nutshell, it's not used very much, and it's always a sure sign that there's a lack of alignment between the investors and the entrepreneurs with respect to valuation. Because what it means is that, let's say you're buying shares at whatever, $5 a share, and then they later sell shares at, let's just say, $1 a share, then all of those shares, the price gets converted down to $1, and you basically just wash out the people who don't hold the ratchet. So in a nutshell, it happens very rarely, but it does happen. I mean, my research shows that at least in the Silicon Valley, about 2% of the deals have a full ratchet, which is amazing to me. And about 97% have broad-based weighted average. This is, of course, in the Valley. And less than 1% have no anti-dilution. I don't know what you guys see here.
I think for in C rounds we don't see it, in A rounds we do see it. I think what's interesting here now, it's very much sort of founder versus new investor, but these clauses can be very detrimental to early other investors, like an angel. Because usually, I mean, the VC understands that the founders are the ones that are going to need incentives to build this company, but may not care too much about an angel. So what you might see is that even if you would have, maybe not a full ratchet, but if you have an aggressive anti-dilution, we and the new investor would probably find a way to compensate the founders, but the angel would be left out, fully washed out.
I've heard that before.
Any angel investors?
No, I think the problem with the ratchet is it's the whole adverse behavior that it creates, and it's unfortunately I've been through that once, and it does hamper the whole company for a year. When you're seeing it, you're going in the wrong direction. Basically, the whole board gets paralyzed, and it really triggers adverse behavior.
Which anti-dilution do you have?
Which one?
Yeah.
In that case, we had a full ratchet.
We had a full ratchet.
Yeah. You know that company, Swedish company.
And
One
we don't
thing
see them.
I'll add is,
We don't see
in a way, convertible debt instrument is a full ratchet. It depends on if there's a valuation cap and the like. But basically what you're doing with convertible debt, which is a very common way to finance early stage companies, at least in the States, I don't know if it's that common here, but you're basically delaying the valuation decision and saying, okay, we're going to take in this money, it's unpriced, and it'll convert into the next round on the same terms as the next round. Sometimes there's a discount, sometimes there's a valuation cap, but in a way, it's a way of the angel doesn't have to argue, is it really 5 million pre-money or is it 2 million pre-money? So in a way, it works kind of like a ratchet.
So regarding the market practice in Finland, in my experience, I would say that in A rounds, you have some anti-dilution provision more often than not, but certainly not always. And I would say that it's always something that can be discussed with the investors. And obviously, it also depends on the valuation of the company. The higher the valuation, the more important it is for investors.
And this high valuation, you would definitely have it on.
No, I think it's a control issue, and I don't like to mix these things with, you know, downside protections against control issue. I think this is a more
but here's actually an interesting thing. Anti-dilution doesn't necessarily have to be related to control, because in Europe, in many cases, you either you issue new shares or buy shares at par value, whereas in most cases in the US, the anti-dilution mechanism only happens at the exit, at the conversion rate. It drives the conversion rate, so it's only an economic issue. It's not a control issue. But in many cases in Europe, you issue shares, new shares at par value, and suddenly they get voting shares, right?
Exactly.
So it becomes taking control issue suddenly, which is, of course, much worse than even having a full ratchet, right?
I mean, there's more. Does everybody understand what he said? It's pure mathematics in the US. It doesn't affect, you know. It's at the later stage, at an exit, that you do all these.
The way anti-dilution works usually in the US is that it sets a conversion rate to common shares. So at the exit, everything converts to common, but the preferred shares, if an anti-dilution event had been happening during the period, there will be calculated an artificial price of how many shares you get for every one preference share, how many common shares you get. But there's nothing issued in between. It's only at exit. So it doesn't influence voting and all these issues. So it's only economic.
It's the same way dividends work.
It's a smart way to do it,
Yeah.
I would say. We usually mostly do that because
Yeah.
we don't really go for control with anti-dilution. We go for economic protection.
Exactly.
Yeah, but in Finland, it's in practice always executed in the manner that if this anti-dilution protection provision is triggered, then the investors would be issued new shares free of charge. So it would obviously change the shareholding percentages already at that stage, and it may result in quite unexpected results for the founders.
Okay, next up, option pool.
Okay. I think this is pretty straightforward, this option pool. First of all, I mean, I hate to say it, but you know, it's a fully diluted basis that you're investing, and a new option pool is a new option pool, and you know, shouldn't be mixed up with this investment. So that's my first take. The second one, which is also pretty straightforward, is I've never seen 20%. I'm typically, you know, you can start with 5, you can go up to 5 more, but that's, you know, up to the board and the shareholders to, you know, when they need more, they can issue more. So the question here, there are 2 questions here: pre, post, and the second one is, you know, is it 5 or 10%?
Right. I mean,
and we got back to this. we go back to this question about the price, as I mentioned before. We agreed on the price, and if we want to keep the price of the shares the same, then basically, you know, this is post, and then we can agree on the amount. You know, I think 10 is 5 or 10 is more preferable.
So as you say, we agreed on the price, and that was including the 20% option pool. So if you want to revisit pre or post here, of course we have to revisit the price.
Exactly.
Absolutely.
And I mean, to be honest, when we invest in a company, we expect there to be a large enough option pool to attract, you know, the people we need to attract. And you know, it's really you know, for us a standard thing to have it pre-investment.
So for me, it's really about, you know, we are in this together. So once you're in here, we jointly decide. So I don't want to have an option pool which I pay for 100%. It's basically, you know, something we give out together. We incentivize new employees together. So the whole arrangement with the option pool is that we do that together.
And then you're asking
and
us,
it dilutes both of us.
You're asking us to invest in a company which probably can't attract key talent. that's sort of part of the package that you come with your company.
No, I'm not saying that. I'm saying that we're paying both of us for that. What you're doing is you're trying to manipulate the price right now.
No, we're putting this in as we always do, pre-investment. So it's more down to you trying to increase the valuation by removing it.
Then I think we are back to square one again. Because
Sounds like it.
Yes.
no, but I think first of all, I mean, in no companies I've built, there has ever been any option pools. So that's between us here. And the second thing is 10% is I'll stick to that. Do you have any comments?
No, I think that we can discuss that whether it should be pre or post, but clearly this 20% is just too far. I think what we would consider reasonable is about 10%.
So today I control 70% of the company. 70% of the company.
With the other
That's
founders.
a lot for a founder raising an A
So
round.
what you're saying to me is that after this I control how much? 30?
33 with other founders.
Yeah. So what you're doing is you're basically taking me down all the way. And this is one of the mechanisms you're using for that. You will be a bigger shareholder than I will be, probably.
We're going to own 27.5%,
Yes, exactly.
right?
You would have 11% personally.
27.5.
We're going to own 27.5%, and that's what we're.
If
we're-
you issue
we're
more
talking
shares, we
about
don't
here.
own 27.5. We just own like 22, or what is it you suggest?
No, what I'm saying here is that, for me, it's a post issue. It's a post investment, then we jointly decide on what the pool is. I don't have any issues with that. If we want to give out 20%, if we agree jointly that that's the best for the company, best for the shareholders, let's go for that. I can live with that one. Because, what we want to do jointly is to create value here. But what I don't want to do is to take down the share price here. So I can invite you in, I can let you play. You have to pay the price that you're paying.
I almost feel like hugging you. I mean, it's so friendly. But I think at the end of the day, I mean, if you tell us that the valuation ramp is like 2.5x what you had,
What?
2.5x what you did 2 months ago, and now you tell us that everything of dilution to other people is going to happen after we invest. I mean, that sounds a little bit
It wasn't
greedy on
2
your
months
own
ago.
ownership.
It was a year ago. It was a year ago. What are you talking about? It was in August 2012.
No, because Brad made a mistake.
You have to read your papers.
No, but the term sheet is May 13, so therefore, of course, that negotiation cannot be November 13. We're not in November yet. It should have said 12. Yes, so that's a mistake.
Okay.
We apologize, of course.
On your behalf.
Let's talk about what typically happens here in terms of, in my experience, I think it's having enough options to get to the next round and not more. What do you guys typically see?
So we typically see a 10% option pool pre-money. So I mean, so it's.
What if it's already used up? It isn't the key thing.
We typically demand it to be extended so that there's a 10% option pool post investment, but taken sort of from the on the pre-money valuation. That's what we have in, I would say, all our investments, except one where we have a 5%. But I would say 10% is our standard, and we take it as here.
But let me make sure I understand that. Let's assume that 7% of the 10% have already been granted. Are you saying that you just add 3% more, or are you saying?
No, we bring it up so there's a 10% non-allocated option pool after the investment.
Non-allocated.
But it's taken from the current investors. So they take that dilution.
Treat the existing, is it fully diluted on?
Yeah.
Okay, so basically all the already non-granted options but allocated options, you basically want to keep them as well.
So we actually let them to be part of the option.
So you let them to be part of the 10%, okay.
Yeah.
No, that's fair.
I think usually the discussion that you usually have on the VC side is to get it to the next round of financing, like if in this case the next B round, what type of organization needs to be put in place, right? And if you have a small fund, it seems like this one, which is closer to a seed round, you probably need more senior level people, filling up, and there you need to make sure that there's room enough to take it to that next round. So I think it really depends on the structure and what in due diligence the VC figures out in terms of what more talent is needed to bring the plan about. But to be honest, we mostly argue for more than 10% at the very early stage. Of course, if it's been an A round of 3 million, it might be different, right? So it's very different from C to A and to B, right?
And it also depends on where you are planning to expand. If you're going to US,
Yeah.
so
Of course.
And also depends on, and actually this could be a tip for the founders, because I would say most VCs would push for that this is in place. So then it's a question about the percentages. And if you're going to sort of argue for 5 versus 20, what makes sense is probably to have a discussion with the VC even before you have the negotiation or option pool on your recruitment needs. For example, if the VC, well, we should have actually room for a new CEO in US, or that could easily be at least 5%, maybe 10% on its own. Versus if you sort of both agree on that we don't need a new CEO within the next 12 months, we actually need these positions. This is sort of roughly what we should allocate for as options for these kind of recruitments. Then you have established a baseline already. So then when the VC comes going for 20%, we just agreed on that we only need 7%, and we maybe should have some extra rooms at 10%. So that's a tip for the founders.
Okay, we're going to take a quick break. Thanks for your attention here. Before we go, I just want to say, I can't remember who the artist was. It might have been Bruce Springsteen, had a song, "Poor man wants to be rich, rich man wants to be king." And the thing that we're going to switch from is moving from discussions regarding economics to control. So think about it in that way, rich man versus king, because the next step we're going to talk about control. And we'll be back in about 5 minutes, okay? We're going to talk about the different ways that the investors can protect their investment. And at the highest level, obviously, the board of directors is the body that's responsible for setting policy, hiring and firing the CEO, that sort of thing. So what we're going to start off with is, and here we're going to really focus on maybe not just the term sheet battle negotiation, but maybe for all of you it might be more interesting to know kind of what the standard practice is here in the Nordic region. And so I'll turn it back to the guys. So let's go.
Okay, so I think the next point that we would like to discuss is the board composition. So basically what you are proposing is that you would be entitled to appoint 2 board members, and then Martti, the angel investor, would have a third board member out of 5. So basically the investors would have a majority at board already at this stage, even if you clearly do not own majority of the shares in the company. And that clearly doesn't sound fair to us.
Okay. You okay?
Yep.
Good.
So you're saying that the founder and the angel, who we very much see as one team here, they have 2 seats and we have 2 seats, and then we elect the independent together. That sounds great.
So let's just maybe we can step a couple of steps backwards here. I think I'm still pissed off at I gave it the
Got
price.
you on the valuation, huh?
Yeah, but the price you got me on the price here, so you still owe me a couple of points.
Give me 10% on option pool.
That was post. First of all, I agree. I have some couple of principles that we adhere to. First of all, the board. It's not like. Okay. The board is basically is not a place of control. The board is a place of creating shareholder value. Do we agree on that one?
No.
Well, I do.
Okay, so can you work this out between yourself first and then?
You go, Jimmy.
Well, I think the board is at least trying to align some of the control issues with the people coming with the ideas and the people coming with the money. And there needs to be some sort of a balance in that.
Yep.
So I would pretty much say that the board is kind of a control issue. That's why we want a little bit of influence for the money we come with.
Let's talk about influence separate, because influence you get from a shareholders meeting. So I mean that we don't have any problem with
There's
that.
many things that are not coming to the shareholder meetings.
But what's the task of the board?
You have said to us that you want our expertise, and therefore we are of course on the board. And we give a lot of expertise, and therefore we are too.
So yeah, we can get back to that one. What do you bring to the table? I mean, I don't see any more than just the money, but that's the second step.
That's a good one.
So let's get back to the kind of the board. Why do we have a board? What's the task of the board in your view?
What's the task?
Yeah. What's the primary task of the board?
Hire and fire the CEO.
Good. I mean that's basically number one. What's the second one? You got that one right?
Yeah, it's higher. That's probably the most important one.
And the second thing is basically setting the strategy for the company.
Yeah.
Okay. So for that we need competence.
That we agree.
Which we bring in droves.
And you bring in that one.
Yes.
So I would say I would argue contrary. I would argue that the board.
Are you saying that Daniel is not competent? I mean, he will be on the board.
I'm okay with him.
I'm going to lose.
That's quite offensive, I would say.
No, but I would argue following. I would say that the board is there for the CEO, and the board is there to support the CEO, and also to represent the shareholders. So the board composition should basically reflect what the strategy of the company is.
The board is there for the company.
Exactly.
Yes.
Exactly. To create the shareholder value.
Fiduciary responsibilities.
So we are back there now, square one. Then it's not a control issue. That's for the shareholders meeting. Now, when you talk about the board members, I feel that the company which is growing quickly, I think probably 4. I think it's reasonable, 4 or 5. What I don't think it's reasonable in this term sheet is that you're asking for a monthly board meeting. I've never seen a company at a fast-paced growing company having monthly board meetings. Or
we can do half of them as a board call, operational update.
Still, I think the whole creating
best interest of the company.
But creating reporting burden, creating all of that, I think it's really unnecessary. Well, we want to involve board members. We want board members who come.
That's why we have more board meetings. It's natural.
I mean, if you turn around in a fast-growing company, there's so much stuff happening that you need to meet on a regular basis.
Yeah, but
there will be a lot of sort of report and financials needing to be done anyway.
Yeah. But the board meeting is not the right place for those. Board meeting is more like that. As we agreed on the board task is to set the strategy and hire and fire the CEO. So where comes in all those operational stuff that you're talking about? I mean, that's the board members' daily task.
We can do half of them as board meetings and half non-board meetings, operational updates and discussions.
But we can discuss that, but typically it's once a quarter. That's my view. Now, when it comes to number of board members, I think that should reflect ownership, and I do agree with. But I think that the composition of the board I'm used to is that the board is primarily external. So we bring in the competence that's needed to create value for the company. So I could be okay with you guys bringing in one person, and we would bring, as founders, we would bring in one person, but the rest would be completely external people.
That would be very usual.
What?
That would be very usual. The VC would not be at the meeting. Is that what you're saying?
Yeah.
Daniel would not be there.
Now, Daniel would be there, but you wouldn't be there.
No, that's I'm already not there. We are suggesting a third party, not me. Don't worry. I'm just here for negotiations.
Yeah, or at least you would not be a board member. I guess you would be board observer if you want to participate in the meetings and contribute to the board work.
I don't want that. I mean, we find an independent, good industry insider, and we have Daniel.
So the second thing is what we see typically is, having all this kind of VC nominated board members, you can never get rid of them. That's a big problem.
Yes. True.
It's
You
hard
can't
to
get rid of them.
get rid of the VC altogether, actually.
But that's a separate issue. So from our point of view, our negotiation point of view is that all the board members should be appointed by the shareholders meeting, should be basically based on the, ownership. We should have the same principle that we are looking for external competence, but there should be no blocking or voting rights that are, over more than your shareholding that you're having. Make sense?
No, it doesn't. And I mean, as an active investor, and this is of course something that we both think that we can bring a lot of value to the companies, and also in regards to our investors, it's super important for us to be on the board. I think we can definitely agree on what the composition should be. If it should be 2 founders, 2 investor representation. If it should be 1 each, and then we go for external parties. I think we can agree on a fair number there.
So I think that's fair. You nominate 1, we nominate 1, and then the shareholders meeting nominates 3.
Yeah, we could probably figure that one out, as long as we have a say.
Yeah. And there's no, you control your board member, but it's the shareholders meeting who controls the rest of the board members. Yeah. So we can get rid of them if they don't perform. On top of this, since we are in agreement here,
so I think given the stage, I mean, you're still a small team. I think maybe it makes more sense to have a three-member board, and that would jointly appoint a chairman. So 1 each, founder gets 1, we get 1, and then a jointly
I don't think
chairman.
that's not going to work. I mean, we are in a very high growth. I think still, get back to the 5.
You will have more board members than employees in your company.
Yeah, well, I will get more competence. I will get more competence, you. Don't you?
Well, if we have to debate competence...
I think the problem with this 1 + 1 + 1 is that, first of all, I will never get rid of that 1. And the second thing is, of course, is that I think, my basic problem comes back to this control issue. I think really that, it should always reflect the ownership. It should always be in the interest of the company, and we should always be able to get rid of those.
But maybe we board members don't agree what's best for the company.
Well, that's up to the shareholders.
Yeah, and also we are going to discuss that a bit more later, but you are requesting a long list of veto rights over issues that are decided at board level, and we are also going to accept most of those veto rights, so you are able to protect your interests by those veto rights.
So you are going to accept the protected provisions?
We are going to accept most of them.
More or less.
Most of them? What does that mean? Which ones don't you? Okay.
Let's get back to that when it's time.
We will get back to that.
But I think what we should do, if you really want to be on the board, Jimmy, we should really be able to appoint a couple of advisors here. We should agree that, you can get 1 observer seat, and we would get 1 observer seat, and that's it.
I live in the US. I don't want to travel to Europe for a board meeting. So
maybe you can phone. You can be on
Daniel
the phone.
is here, so he...
Yeah.
But we could live with either of those.
Okay, good, because then I think we agree.
Couple questions for these outside directors. Curious, how do you compensate them? And secondly, what about D&O insurance? Is that common over here?
Mandatory?
Directors and officers insurance for outside directors who assume the fiduciary responsibility of sitting on a board. I'm just curious.
Yeah, we usually ask for D&O insurance. Yeah. I think it's quite common. Yeah. But it's for all board members, right?
Yes.
It's not
Yeah.
also for executives and for boards.
Yeah.
So
We do as well.
About the compensation, I think, from my point, my experience is that chairman gets most, like 1%, 0.5%, something like that, in between there. Board members, 0.5%, a little bit less, depending on if they are investing themselves as well in money. I think it would be preferable if half of their shares would be investment. Would make sense.
yeah, I think that would be good, but it's not always. Sometimes you also invite people that just brings in really competence from a particular industry, and maybe they don't want to invest, only have the upside. I think at the end of the day, it's depending on who can you get in.
But you never
And then there might
pay.
be compensation. Well, we do sometimes. It depends a little bit on the stage of the company. I mean, so we have investments or companies that are now sort of, large companies,
Yeah.
and where we are looking for external board members who, would expect some compensation.
Yeah.
Still not sort of full value, perhaps, but some compensation, yes.
And compensation in terms of fixed fee, monthly fee.
Yeah, could be yearly.
That
a little
depends
bit.
on the jurisdiction, I think.
Okay.
In Europe, I think a mix of the two, like fixed and upside, is normal. I think in the US, asking for fixed fee is very uncommon. Very
understand.
uncommon.
But now we just forgot one issue. How about me?
Yeah, you're welcome to report to us in the board every month.
Shit.
Okay, next up, we're going to talk about
You forgot that one, huh?
protective provisions.
Just a question, since we came into a discussion here about the VC's representation or even not. And I mean, as an active investor, I think pretty much all VCs would demand at least one board seat.
Yes.
It would be extremely strange to not have that. And we try to, and this is different from firm to firm. Some VCs wants to have the chairman seat, gives them a little bit more, perhaps, feel of control or something. We typically want to have an independent board members, definitely the chairman, and then a fair representation of founders and VCs. So we're not looking for the control in terms of number of votes.
I think this is the most typical, this is one of those traps that you can end up in, that you don't, as a founder, you don't really care about this more. But in the end, this is one of the things that if you lose the control of the board, that's really where, this is really where you should think through.
Yeah. But I think most VCs, they don't really see the board structure as a way to get control, to be honest. I think at the end of the day, I think if you can have a board member that is truly independent of any interest, and sometimes mediates the discussion between founders themselves, right? And sometimes between founders and investors, and play sort of the mediating role that is, maybe strong-minded and can get things through and create also respect at the end of the table. I think that makes a lot of sense. Not putting the control to either founders or VCs, to be honest.
And what's usually a very bad situation is when you have a lot of investors and they all want to be on the board. That can create a lot of interesting problems and challenges.
And they're all very, very good, and they all have their own opinions, and board meetings takes like 5 hours.
And there are ways to get around that, force the VCs to make up their mind who should be representative, and then have almost like side discussions or side letters. And similar on the founders, we don't like to have all founders on the board. Better to have a representative and then opt for external.
I think 5 members is more or less, that's the optimal, not more
But
than
5 members in a
3
very
to
small
5.
company doesn't make sense. I mean, you spend more time on board meetings at 12 a year. I mean, it doesn't make sense at all, right? I mean,
Yeah, okay,
you want to
but-
build a business, you're 5 people, and you don't want to spend hours and hours every month to report to the board.
A monthly board meetings is really unnecessary, I would say, as well.
We typically have them in the early stages.
Yeah. It creates a lot of overhead.
We have usually 8 a year, and we
Yeah,
have
it
4
probably comes
operational discussions and so on, in between all the other discussions that you usually have over time. And then you have 4 to 5 formal board meetings.
Yeah,
We
that
usually-
makes sense. Makes sense, a lot of sense. 4 plus 4 plus 4.
Okay, so Kimmo, you're going to tell us what protective provisions are and how those are different than just the board rights where the board meets, because contractually there's other ways to exercise influence, right?
Yes, so basically, normally at the shareholder meeting minutes you make, or shareholder meetings you make resolutions by simple majority. So whoever has majority of the shares at shareholder meetings can make the decision. Sometimes you have some higher percentages that have to be made. At board level, you always make decisions by simple majority. So whoever has majority of the board members on his side can make the decisions. And obviously, normally VC investors, they don't have majority either at board or at shareholder meeting minutes, but they still, or shareholder meetings, but they still want to control that board or shareholder meetings don't make any decisions that are adverse to them. And because of that, they want to have usually a long list of veto rights over matters that are decided at board or shareholder meeting level. So that's what we're going to discuss about. Yes. So in this term sheet, you have listed several issues over which you would like to have veto rights. And I think that mostly we would consider that list quite standard. I think the most problematic for us was that you would have veto rights over issuance of new shares in the company, which basically means that you would have veto rights over new investors. So if a company would find some new investor and would need that money, you could block that investment, and then there's really no other alternatives for company than ask that money from you, probably for some much lower valuation. So basically, you could hijack the company. So that's what we are most worried about.
Right?
We agreed already to skip that one. But anyhow, I think we are. This is pretty standard. We don't have any problems with this. I mean, remember that some of these can be business critical. So I mean, that is if any, I think the issuance of new stocks shares is business critical. I think that's the one we should remove. Otherwise, I think I can live with the rest of them.
Yeah, and particularly because you already have according to this term sheet, you have pro rata subscription right. So whenever new shares are issued at the company, you can subscribe your percentage of the shares that are at issue. So why would you need this kind of veto rights over new investors?
Or we can start going through this list if we want.
We are not interested in hijacking the company. We want to build the company together, of course. What we want to make sure is that we don't get investors in that can have adverse effect on more independent, like could be a strategic investor you want to invite, that we say that doesn't bring forward the best interest of the company and the shareholders, because there are some other strings attached with that investment, so we want to have a say in that. But of course, we don't want to block the company, so I think what we discussed as a compromise would maybe be to have, if we are coming to a scenario, even though this is very unlikely, of course, with this funding, the company is going to be break even, of course. But should the unlikely event then happen that the company actually starts to, you can see that it starts to run dry, for instance, in 6 months, then we cannot block it anymore. Then you are free to fundraise. Then you have 6 months to fundraise. That be okay. But generally, we want to have a say in the fundraising process, also to sort of make sure that we don't get funny clauses from strategic investors in there.
Let's do it this way instead. Let's turn it around a little bit here. That if it's below the existing valuation, then you will have the right to block. If it's above, no block rights.
I think we're still not solving the issue of bringing in a investor which may not be, value creating.
But that's hypothetical.
They're
Can you give me a list? Can you give me a list of the ones which are not acceptable for you, and then we can agree on that one?
What if we change the course of the business in 6 months and you pivot into another market? And
we can't change the course of the business according to this. You have the protective rights.
Of course, that's a protective provision.
So that was no issue.
I take that back.
And
Good point.
why would the other shareholders want to bring in investors who don't bring value to the company and who would not be beneficial for the
They
company?
pay a higher price, but there's some strings attached, and they on the sidelines they promise you to give you a great job when they acquire at a lower valuation, but they still up the round.
Yeah, but let's leave a hypothetical question.
That's not
discussion.
hypothetical.
That's a
That
very-
has happened
that
many
is a
times,
very,
unfortunately.
realistic question.
Yeah, I think what we could agree is that if those potential investors, if they are not really arm's length investors, if they are somehow too close to the current shareholders, some kind of entities that current shareholders have some
So we have a
attachments, then you
protected
could
provision in this one if it is a non-financial investor. Then we have a say.
No,
If it's
I
a
don't think
financial
so.
investor, it's
No.
okay.
I think your suggestion with arm's length is perfect. That
Yeah,
will solve the
that
issue.
would really solve your problem.
Yeah.
That there may be good reasons to get also strategic investors to the company.
So tell us again, how would that work?
Sorry?
How would it work? Tell us again.
It would work so that if those potential new investors, if they would not really be arm's length investors, if they would be like some family members of the founders or something like that, some entities to which founders have some close attachments, then you could block that kind of investors. Arm's length. So I would say that like not.
Some have
somehow-
short arms, some have long arms, and
Well, that's perhaps.
I don't know what that means. I mean,
Legalese, but.
It's as hypothetical as yours.
Yeah.
strategic VCs usually have long arms and
I would say that
Long fingers as well.
yes.
Yeah. If the current shareholders don't have any like personal interests in those new investors, then you shouldn't really be able to block that kind of investors. Then the assumption must be that they are beneficial for the company and all shareholders and also for you.
I think that applies, now when we're coming into this discussion, I think that also applies to the drag along stuff.
Yeah.
So we can,
We will come back to
it's a very good bridge now to the drag along.
Okay.
So Kimmo, can you first describe what a drag-along right is?
What's that? Sorry.
Can you describe what a drag-along right is?
Okay, so drag-along right is that whoever has drag-along right can force the other shareholders to do the exit. Basically, if, for example, if drag-along provision says that if majority of the shareholders wish to sell the company, then those majority shareholders can force also the minority shareholders to sell. And obviously, it's particularly for VC investors, it's important that they are able to do full exit. So that's the purpose of drag-along provision. So you can drag even those shareholders who would not wish to exit, you can drag them also to exit.
It's getting more complicated all the time. Everybody following? Did you have any comments from the last one?
Yeah, I did. What I wanted to bring up, I mean, I think it is quite a realistic scenario that you have a strategic investor, and they're actually getting more and more of them, and fewer ordinary VCs. And there is a point where, for example, you might have a scenario where a strategic might offer a higher valuation, and the VC or the founders, but the VC wants to have some say in not just going for that because it looks attractive, if it has potentially a detrimental aspect on the exit value. So you're limiting your exit options, you're getting in bed with a strategic that is then becoming the most likely acquirer, and that is the situation, which is not the theoretical situation at all, but actually getting more and more common. So that's sort of where the VC is coming from.
Unlike many of the other things in term sheet, protected provisions here is actually, they're pretty standard.
Yeah.
Actually, in
that's
the
okay.
true meaning of it.
Yeah. Okay, the drag along stuff. So what's your logic there?
I mean, as you say, in a scenario where there is a good deal on the table, we don't want to have it stuck, but we want to make sure that we can make a full exit.
So a good deal for who?
Good deal for us, which is, of course, a good deal for you as well. So our reasoning of having full control. I mean, this is really our business, right? So making sure that
control.
Sorry.
Business of having full control.
No, in the business of making money on the investments we do, choosing the right exit timing, and thus we want to be in control of when that happens. We also have the fund length perspective. So of course we have limitations, very very concrete limitations that forces us to have the possibility to get to an exit.
To be honest, I don't care about those. Those are not my problem.
Then you probably shouldn't take VC money.
That we can take another discussion. I agree with you there as well.
Yeah. But with respect to these track-along provisions, now it says that the holders of majority of preferred shares would have a track-along right. So basically,
Good deal.
you could already track along as soon as you wish, even if the majority of the shareholders would not like to sell the company. So we think that at minimum, in addition to majority of the preferred shares, also majority or perhaps 60% of all the shares of the company has to support that exit.
I think that's pretty common. I would say that you need both, so you can't have just one. You need both, and that's where you need to convince us also that it's a good deal for us. So we're on the same table. That's one thing. So that's a 50-50 one. The other one, when it comes to drag along, I think we talked about this arm's length. I think there is no drag to any closely related friends of yours. So that's another one we want in.
We have no friends, so it's not a problem.
We've seen too many of you, when you have shitty companies and you want to combine these and create two shitty entities. So sorry for that, Jimmy.
That's a fair request, by the way.
Yeah. So that one. What we can give to you guys, we can give you a protected drag. So basically that if we by giving you the 50% no say, basically you get the downside protection as well. But what we want is an upside. So when the kind of the exit value is below certain above a certain valuation, you will have no drag along there anymore. Make sense?
When it's above a certain valuation?
Yeah. So basically that we want the protection on so that you can drag us for any valuation. So downside protection. We want that downside protection. Make sense?
Not really.
So you can drag us, for example, for 1 million.
But you want that, or?
Yeah, we want that. We want that protection.
We cannot drag you at
Yeah.
1 million.
Yeah.
So, but the
So
suggestion
it would somehow connect, for example, to the liquidation preference.
The suggestion was majority of the pref shares, which in this scenario would be us.
And
at least at this
majority,
stage. And then
That's the first.
And then
all
60% of all shares.
50% of all shares.
50% of all
Yeah.
shares.
So that's the
Okay.
first one. So if we can agree on that one, the rest we can leave.
I think that's isn't that a fair principle? I think so.
I think so.
So it has to be both. Good.
I have a question.
It's
It's actually, and we're going to have to speed it up a little bit, but have the VCs ever experienced a situation where they felt like they got dragged along by the founders who wanted to sell maybe at a nice price for the founders, but maybe not a huge multiple for the VCs, even though there's no contractual right, they kind of got dragged along. Has that ever happened?
Yeah, I mean,
Rarely, I think. It's usually the other way where the VC is a little bit concerned that it becomes the big perspective of the 400 million exit. 3 years pass, and founders get comfortable and are not really moving anywhere. It's kind of being a little bit of a zombie, and they have fun and they don't work that hard anymore, and the perspective of 400 is suddenly like 25, and at some point you want to say, okay, what should we do about this company? So, and therefore you have these drag rights. But I think in normal circumstance you would have, at least mostly what we do is you have the preference shares can drag, but cannot drag alone. So at least you have to convince 1 or 2 founders or a certain majority of all shares. So that's very common, I think. And then in some cases we put in, after a period of time, say 5 years or 6 years or something like that, we have what we call an exit right, where some of the clauses might change a little bit, where it becomes, at least we can initiate an exit process or something like that.
Yeah,
That's usually what happens.
That's what I was looking for when
Yeah.
it's
I mean, and there is an aspect of, you asked if the other way around, and I mean, in reality, it's really hard for VC to sell a company if the founders don't want to sell the company, and the founders are still relevant in the company. I mean, the acquirer is not buying the VCs; they're usually buying the company and the key people. So there is this disadvantage, if you like, or this power play, which is especially with strong, good founders. You know, they probably have more power than what you think of when you look at these contracts and terms. And we, you know, at the end of the day, we can have whatever kind of terms. Still, things might get totally, you know, put to the side if founders decide to sell and the acquirer is on their side. It can be really tough for the VC to stop that, even if we have some of these rights.
If it's a very low exit and VC wants to get out and you need to use the drag clause, what usually happens is that there's nothing for the founders. And of course, then the acquirer would say, why would I buy it if the founders get nothing? So then you renegotiate.
Yeah.
If it's a very high exit, then the acquirer usually buys it for the business and for the team also. So therefore, drag doesn't make sense, right, either. So there are some middle ground scenarios where there can be drag rights, but it's, I would say, I think I've seen it once. We have never forced it, but I think I've seen it once used. And I've seen it used in smaller exits, but always renegotiation.
No. Good point.
Okay. A different way to get liquidity is through redemption rights.
Is this lawful in Finland, by the way?
Well, I guess it would be.
I'm not from Finland.
It would be legal, but it would be really unusual and really unreasonable. So well, obviously, first of all, to be able to redeem your shares, the company would have to have distributable profits, and well, it may or may not have those. But even if it would have distributable profits, it would really be unreasonable that the company could basically be put in a cash-strapped position by having to buy you out. So you are always free to sell your shares.
This covers the scenarios where founders really want to continue with a cozy business,
but you are always free to sell your
consultancy,
shares,
and they are free to do so. They can just pay us out.
I think this one is basically more or less off the table. I think this is not a negotiable thing.
Non-negotiable.
Yeah, because it's a high risk. There's a lot of issues with this one, with the redemption right. I think it's not interesting for us at all to have it there, even negotiate about it.
What's your concern?
My concern is purely that this puts the whole company into a major risk, and this kind of having this kind of time bombs there is not something I can live with as a CEO, as a shareholder. I'm not willing to at all accept these kind of clauses.
How are we going to sell?
I mean, we need to, our fund lifetime is 10 years, and at some point we need to exit.
You're always free to sell the shares.
Yeah, you're free to exit whenever you want.
Yeah, but putting the company at risk for your interest is not what we're going to accept.
Okay, in the interest of just kind of moving along here, I will say that in the U.S., in the last quarter, 14% of the deals had registration or redemption rights. My experience here is that very few of these deals in the Nordic region have them. Is that right? Very few?
We never see them anymore.
Never seen them?
We used to see them, but we don't see them anymore.
Yeah, so probably don't need to talk about that. But it does raise the issue of, is it a lever to force the company to provide liquidity? One thing that my research shows is that in the most current quarter, the median time frame from an initial equity investment to an IPO has now increased, and these are USA stats, to 9.4 years. And the median amount raised for companies that do achieve an IPO is 105 million. So when you think about a VC fund having a 10-year life and the median time frame being almost 10 years, you can see why having some lever to force liquidity is kind of important. So let's also talk about, I guess we're going to move on to right of first refusal and right of co-sale, because I would say that that also has a similar issue for the founders.
Yeah. Here I'd like to come back to one thing we never touched upon here, which I think is quite critical, how to treat the founders. We always talk about all shareholders being equal, but this is one thing where I think we should sit in the same boat. This is one thing where, you know, if you want the right of first refusal, I, as a founder, want the same thing. And it's pretty logical. So that's my kind of takeaway from this one.
Yes, and obviously the same applies to right of co-sale. So if you exit from the company, then you have to enable the founders exit at the same time.
Makes sense?
Otherwise, you could sell your, let's say, 1/3 of the company to some hostile party who would be happy with that 1/3, and then the founders would have no opportunity to exit, because nobody would be interested in 2/3 of the company anymore.
Do you even have one to fill here? Yeah. This is one we couldn't even come up with a good counter reply. I think that's a pretty fair. Change, actually.
Okay. Good. Thank
so
you.
the stuff in here is not so what we see normally, actually.
No, I think it's pretty high point.
Yeah.
Then we can talk about those vested shares, but that's a second. Can we?
Well, the one problem with the suggestion, I think, is that you have different classes of shares.
Yeah.
So common stock is worth less than preferred stock. So, you know, but it may be that there are investors who would be happy to pay the same. I don't know. That certainly did happen a couple of years ago with some Russian investors who were buying stock in late stage US companies. But the other thing I'd point out, if you guys aren't aware of it in the audience, there's an emerging secondary market, and NASDAQ and SharesPost have now created a secondary market where founders, departed employees, and others can sell their shares. And that turns out to be, you know, pretty interesting market, and a lot of people have made a fair amount of money selling shares in the secondary market in the United States. My sense is that that market really hasn't developed as much over here, except for maybe the best European companies that I don't know. I'm curious what you guys see.
Well, it's very limited of the secondary market, aside of the classical secondary funds that go in and bid more on pools of like whole portfolios of VCs or other people's portfolios, but they trade it as a whole portfolio. So deal by deal, it's fairly rare, I would say. Of course, there's more of a marketplace in the US for these things. I think what's common, at least in the Nordic area, I think it's more common that you have that founders and investors have co-sale and right of first refusal rights more equally. Obviously, in reality, that right is worth only a lot to the founders if they can pay with cash. And they are usually, the VC and the investors have usually more cash back home and can actually use that right. So it might sound more sort of equal to have a common right, but in reality, in most cases, it's not going to happen. It is a de facto right for the investor. But it's more democratic to have it all. And of course, there could be other investors, but I think the more democratic way is that both have it.
I think another point on the, and especially with the second market that has become more apparent, is of course what happens when employees or even founders start having possibility to sell shares. And this is not only from the VC point of view, it's actually from founders' point of view as well, or the whole company, that it can introduce quite a bit of disturbances. Imagine that you're going out for fundraising in 6 months, and all of a sudden there's popping up all these secondary shares selling for all kinds of prices, and that's not always in the interest of the founders as well.
Usually, or in many cases, there's kind of a lockup in which founders cannot really sell, but then there can be carve-outs to the lockup, say like 10% can be sold, or some liquidity, and even in some cases, if the valuation ramp is very quickly, and suddenly there's a lot of value for the founders. The concern that the VC has is actually that there's a lot of founders that get a little bit too trigger happy about the exit, whereas they start to see the potential can be even higher and assume more risk. And then in those cases, of course, that carve-out is really allowed, and you're allowed to realize liquidity. We have been in several cases where we actually had a lockup, but we actually allowed that, money to come off the table in such a way that we could drive for the bigger exit, and not, founders really saying, okay, if I could get 100 million in the bank right now, it's okay.
Do you allow tag-alongs for all shareholders?
Yeah.
Because that can be quite an effective way of blocking.
Yeah.
Also, that's the one.
If all has the usual 1% and 1%, and then it's de facto blocking, right?
Yeah.
And then you could say, but then on the other hand, then everybody's in the same boat, right? We're in it together, right? So that would be democratic too.
Okay.
Okay, we're going to bring it on home with one more round, which is the no shop and confidentiality. And Kimmo, again, if you could describe why those provisions exist and what they mean in terms of being able to get a better offer.
Yeah, well, first, I guess as a background, I should say that that normally, or basically always, term sheet is not binding document, apart from a couple of provisions. And the binding provisions are basically no-shop provision and confidentiality provision, and perhaps the third-party expenses provision. So no-shop provision, it basically means that during certain no-shop period, the company cannot look for any other investors. So when the term sheet is signed, then the investors start to spend money on due diligence and everything else, and they want to make sure that they have a certain time period to do due diligence and to negotiate the final agreements. And during that time period, the founders have to concentrate on that transaction and not look for better transactions. And then obviously confidentiality provision, it's important particularly for the company, so that whatever confidential information the investors get during due diligence, that they don't disclose that information, for example, to the other portfolio companies that may be competitors.
Okay. Guys, you're full of tricks, I can say that. Have everyone read this term sheet? It says on the first page, it says, this term sheet is not commitment to invest and is conditioned on the completion of due diligence, blah, blah, blah. No shop confidentiality and counsel expenses provision. This term sheet shall be binding obligations, whether or not the financing is consummated. So you want me to pay your fees if you drop out?
Yes. Very customary.
Okay. I just wanted to highlight this to people so that they know that, there are lots of tricks and treats here.
And so what about if we want to drop out? Are you willing to pay our fees? I'm not free.
We didn't ask him to bring you here,
You're not free, but are you cheap? That's
Okay. So, first of all, I just, wanted to, I read this document. 8 weeks, you're killing the company. I mean, that's really, 8 weeks.
Almost profitable.
No, but what I'm saying here is that you want a no-shop of 8 weeks. I mean, I've never heard about that. let me ask this way instead. You talked earlier about this, what kind of recruitment do we need to do? And how much options do we allocate? So what do you need 8 weeks for? Tell me.
So there's the lawyers, they have so much to do and they work so slow. So
They turn papers.
of course, we're going to have the intention. I mean, our intention is to be faster, but we don't want to have this term sheet exploding, and I don't think you want to have that either. So that's where we want to have a bit more time to make sure that we can perform sort of a due diligence that we're comfortable with, without the term sheet exploding.
Okay, and
What does that mean, the term sheet exploding?
Well, yeah. Actually, it's maybe wrong use of term. Usually term sheet exploding is actually from when we hand it over until it's signed. So not appropriately used in this phase, perhaps.
But well, here the company is 1 year old, so I guess there isn't really that much due diligence to be done.
Then there's all the documents and drafting.
There was this freedom to operate on all the IP, wasn't there? I mean, those litigation attorneys in the US, that would take at least 6 weeks. At least.
There are no such issues.
And gonna exceed the 25 euros, which then the remainder of that cost we will actually spend, and you will keep the material even. So.
Anyhow, so let's put this straight. First of all, this term sheet is pretty good, so it's pretty comfortable. I mean, I would understand if you would come with a 2-pager or something like that. Then I would understand that you need more time. But with this term sheet, this negotiation where we're almost ready, I would say completion takes 4 weeks maximum, 2 to 4 weeks. So that's kind of...
It never takes 2 to 4 weeks.
So that's my kind of takeaway.
Never
here.
takes 8 either.
Why I don't want 8 weeks either is that you would basically kill the company. And that's a very efficient way of killing it. You would kill the tempo of the fundraising, you would withdraw, we should pay your fees, we need to restart the whole fundraising. You would basically kill the company.
No, you misunderstood. We just renegotiate in the end.
I'm not negotiating.
No, but I mean, when you are closer to the edge, then it's going to be a better deal for us. So.
Exactly.
That's why we need 8 weeks.
Okay, so 4 weeks, that's okay for you guys.
I think so.
The cap, I think it's okay, to be honest. I think 25K, somewhere around, well, let's make 2
you
to 3%.
can say that. We would pay it anyway. It comes out of the investment.
Yeah, well, it's okay. I think it's okay. But, if it's a breakup, we're not going to pay for you guys. That's for certain.
We have done 50-50 from time to time.
No. You would need to pay us the breakup fee. Sorry for that. But you pay us the breakup fee. That's what we want.
For us finding things in the due diligence that sort of makes the company uninvestable.
No, you basically already have access to all the information. So let's say 100,000, 100K for breakup fee. I mean, that would basically take us a little bit far down the road and restart the process.
Breakup fee.
Yeah?
We never...
We never do breakup fees.
Okay, so we agree on the cap, we agree on the 4 weeks, and we agree on the breakup fee. So I think
No breakup fee.
No breakup fee.
okay,
no breakup
well, everything else we agree on.
Yes.
Okay, that's it.
I think we have a deal.
We have a deal.
Don't you have any
Okay, so thanks for everyone's patience. I think before we wrap it up, Lars, you were going to come up and say a few words. And if anyone wants to get a hold of the cast, this is the...
Hey, just one comment. I mean, we discuss all these legal terms and all these things, and hopefully educational.
Okay.
Hopefully you will go out and meet a lot of VCs, so there is competitive pressure on the other side of the table. So meet 10, dance with 3, choose one, and don't take the best deal, take the one where the chemistry is the best. because you're going to live with these bastards for a while. So you want to make sure that you choose one where you can actually have a meaningful discussion that's logical, pragmatic, and so on over time, where you feel comfortable. Don't take the best deal.
Yeah, and I would argue exactly like you do. I would say that, if you put up 10 parameters and you evaluate the ones, it's not also about feeling the best. Do they really understand your business that you are in?
Yeah.
Because otherwise they will shoot you with questions that are completely irrelevant for all the time. And it's for good, but it kills the company. Yeah. So I would go for an evaluation, and amount is just 2 parameters out of 10, and then you have to figure out the 8 other parameters. And in the end, compare based on all of those 10, don't go for the valuation or the price. I myself, last company we raised money from a US-based investor, Axel, and they by far had the lowest valuation. But they had, most of the other ticks were right.
And another point in terms of, a lot of the stuff in here was like over the top. It was not something that we typically see, but there are definitely things which are, pretty standard. And it helps, competition is the way to get the non-standard things. The more competition, the more eager the VC is to do. That's sort of when you get through certain things which even the VC would, maybe admit is our exceptions. But it's oftentimes good to know what is the standard, what is something which I just don't spend time on this one, because every VC would hammer it to go for it. Versus other thing, really trying to find out what is the important things.
But don't accept these guys, standard stuff. Go and check it out always, because what you guys say is standard might not be standard for me.
No, absolutely. But
there's no standard.
Exactly.
Except the standards.
Does anyone have questions?
One question.
Yes.
Do you have another version of the term sheet where you have marked those things that are non-standard? We should not worry about. They should be off the table. You said many of those would not do.
Not many, but for example, if you go to VC, they will request a board seat. If you're not willing to accept that, you shouldn't have a VC on board. 2x participate in LickPref, you're in a really shitty position if you have to accept that one. And maybe that is an idea.
Yeah, I can kind of address your question, because it's an age-old thing where a lot of people have tried to come up with the standard, and that's been tried in the United States by many people. And I don't know what it is about lawyers, but everybody thinks their forms are the best, the lawyers I know. But there are some forms that exist, and you can find them. Brad Feld published a book. He's a VC in the United States called Venture Deals, and he goes through what kind of he considers standard. But there's at least 3 or 4 different versions. And one of the things I got involved with in the United States, I was chair of the Venture Capital and Private Equity Committee of the American Bar Association, and we started a project in, I don't know, might have been 1990 something, where we were going to come up with standard terms and publish those, and then some folks on the East Coast beat us to the punch and published their standard terms, and they were published through the National Venture Capital Association, and you can go to that website, nvca.org, I think it is, and they have their standards. And then we, on the West Coast, I'm a West Coast guy, we're like, well, that's not standard. It's not standard here. And so then we actually published a commentary, a model commentary. And so this kind of thing goes on, and I don't know if it's happening here in Europe. I think in the UK, they tried to do something similar. I've heard from Alex Farset with Startup Bootcamp that there's an initiative down in Berlin to try and do something like this. But at the end of the day, everything is negotiable.
That's a general rule of thumb, I think, that I've seen. The younger the VC would be, or the fewer the years that the VC have been in the game, the more sophisticated complexity models and so on, the longer you've been in the time and have to redo all that shit later, the more simple it becomes over time.
Yeah,
because you waste so much time and
simplicity
a lot
of
lawyers' time and all.
Yeah. You have
No, I just had one last point before you close up, is that we didn't discuss really this, there's a ghost called dividends, which is really goes back to, you being, being able to, do your carry towards your investors. Don't ever accept that one. That's an easy negotiation point. Take that away. Because in the end, that can hurt you as well. I mean, if the average is 10 years, and you take a compound rate on 8% over 10 years, it's a pretty hefty liquidation preference on that one.
Well,
So
it's another way of getting a 2x.
Yeah,
you can
exactly.
say it's not a 2x, but if you put cumulative dividends, it's like
10% 5-year.
Yeah,
2x.
Albert Einstein said the greatest invention was compound interest, or something like that, and that's effectively what cumulative dividends are. But anyway, any other questions before we give it to Lars to bring it home? Yes.
Management fee.
Where the company's paying the VC a management fee? Yeah,
it's a finished.
I don't think you see that too much, do you?
No, it's
we
a finished
we
thing.
never see it.
It's Tekes things.
We expect sort of travel and sort of travel expenses or out-of-pocket expenses. That's it. We never have any.
Cheapest hotel.
Pretty much.
And then we take the management fee.
Well, plus it depends on what the limited partners negotiate, because the limited partners want you to return capital, not earn management fees, right?
So basically, our investors, they also work hard on us, and they don't want to pay us a lot, and all these things, of course. And the way they structure that is that if we start to collect fees, they see it just as our management fee.
Yep.
So that's just being deducted in our own management fee later. So there's no sense that we are trying to do that. Our LPA agreements, which corresponds to the shareholder agreement in the portfolio companies, regulates all that. So we don't charge that, of course.
But I think he's talking about the Finnish Development Fund or agency, whatever they're called, Tekes.
You have some mostly government funds, I think mostly in the Nordic areas, also Germany, where they would invest, €750 as a seed, and then would do a consultancy report, and they would do as a board member, and value add, and
that's the way of them
and
of
then
creating jobs.
350 goes back, right?
But they also don't negotiate as hard on valuation, right? So maybe that sounds like, again, I don't know, that could be a good deal.
If you're in that scenario, you need to see more VCs. Let's
Yeah.
put it that way.
All right, there we go.
Obviously, the VCs are looking at what companies they want to initiate discussions with. Are there any kinds of alarm bells that sometimes should be ringing for us entrepreneurs in terms of we should consider not even start discussing with some people who look big and powerful and
Can I answer that question? Because I had the same discussion earlier here with Antti a little bit. And I think, before you go to VCs, I mean, VCs are primarily, they're great people, but there are some certain, there are VCs who is a waste of time. Reason being, and that you can elaborate more on, Daniel being in a really nice position now, having just raised a fund, being able to invest now, but there's a lot of VCs out there who are more or less, they cannot make any investment anymore, and they're just wasting your time. So if you're not looking in basically looking at, what stage of the fund they are in, there can be a lot of waste of time for you. Then there are these big VCs, who continuously year after year, raise new funds. So they are in an investment mode all the time. So, so you should really, do your homework before you start, contacting VCs, and not just take the ones, that you have on the phone list in the Nordics. Check, what are their funds, what are their availability, and what is the timing.
Yeah, you should basically ask the VC, before you meet the VC, you should ask for the vintage year. The vintage year is the formation year of the fund, and you can pretty much stack on 5 years to that. If that's more than 5 years ago, they cannot make new deals, period.
Good point.
And talk around to fellow entrepreneurs and ask for their experiences. And ask the VC to provide references as well.
And good VCs provide good references. I think that's a very good one.
Ask their portfolio companies, yeah.
Yeah, exactly.
Okay, Lars, bring us home.
I thought this was amazing. This is third time I'm in a term sheet battle, and it struck me how different the dynamics is. Kind of, you have this good cop, bad cop strategy. Last time I was in a term sheet battle, it was the other way around. The lawyer was doing all the pounding. Completely changes the thing. The guys over here, the most scary thing is that Crandom and Sunstone have actually syndicated together before. So who wants to meet these two guys in one meeting? But this whole sarcastic cop, nasty cop, that also worked fine.
That was for the show.
And I think you actually didn't even practice that. That was just natural.
We are actually nice guys, you know.
Yeah. We get all the middle things, yes. So that was super cool. If you agree with me that this was amazing, please go and tweet about this, comment on the blogs. Brad and I and Martin, Morten, a couple of guys here is actually continuing to Stockholm now and doing this show again with a new cast on Friday. So anything you guys put in there, like give it a positive vibe, it will attract more people and hopefully more guys having this huge opportunity to, yeah, Miki, you're getting warm.
Yeah, I was just about to say, this is one of the greatest things I've ever, from an entrepreneur point of view, this is really true value. So please come back, do this again, because this is where the entrepreneur should be, because this is where everything goes wrong.
Yeah.
Sounds like you have experience.
Was it a better or worse term sheet than this?
And I think
Full ratchet anti-dilution, I suppose.
And I think, first of all, a big thanks to Brad for making the whole platform here, preparing the documents together with Kimmo and making the local version happen. And thanks to you guys for really showing the honesty here, I think, to tell us also what was behind the theater and what is the normal practice. So please join me in giving a big hand to the whole cast and Brad here.